Eldrigo Namaskara. Hearty welcome to Jnanarjane, Empowering Excellence. Friends, today we stepped into day 2 of 6 days workshop on international taxation. Today we have very interesting session, section 9, an important topic in international taxation is section 9. To enlighten on this topic, we have two eminent speakers from Mumbai, CA Ganesh Rajagopalan and CA Rutvik Sanghvi. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Ganesh Rajagopalan. Hearty welcome, sir. On behalf of Bangalore branch and on behalf of all the participants and panelists here, hearty welcome to CA Rutvik Sanghvi. Hearty welcome, Rutvik.
Thank you. Thank you.
Friends, our program coordinator, CA Kota Sri S. Srinivas, past SARC chairman with us. Hearty welcome to CA Kota Srinivas. My colleague in MC, CA Divya is with us. Hearty welcome to Divya. Friends, you are the reason for this program, this 6 days workshop. Hearty welcome to each one of you. I'll take a minute of yours to inform about our upcoming program. 21st International Yoga Day. Your branch is hosting International Yoga Day from 7:30 to 9 on 21st of June, Monday, 7:30 to 9 Yoga Day we are celebrating in our branch. I request all of you to register that program. 27th June is International MSME Day. We are hosting program along with Pinya Industries Association. So I request all of you to join that program. To inaugurate that program, our Minister for Industries of large and medium scale industries, Government of Karnataka, Jagadish Shettar is joining to inaugurate that International MSME Day. I request all of you to join. It is along with Pinya Industries Association. Pinya Industries having more than 6,000 members. They are also joining that program. I request maximum participation from chartered accountants is requested. Please join that program. And 1st July is CA Day, is our day that we are celebrating from 9:30 a.m. to 7. Very interesting program lined up for our day, CA Day on 1st July. I request please visit bangaloreci.org and look into that program and register for that. With that note, hearty welcome to each one of you. Hearty welcome to our renowned speakers. That note, over to CA Kota Srinivas. Yes, our Vice Chairman also joined, CA Srinivas T. Hearty welcome to you. Yes, over to Kota Srinivas.
Thank you, Chairman. Welcome to Chairman and all the panelists, the Vice Chairman Srinivas T. and also Divya, the Secretary of Branch, the speakers for the day, Rutvik Sanghvi and Ganesh Rajagopalan, and all the participants who have logged in know more about this particular topic, Section 9. In fact, yesterday we had two stalwarts who spoke about overview of international taxation, and then we learned something about scope of income under Section 5 and the residential status of under Section 6. Now, any international taxation, if you want to know or if you want to learn, the gateway, like we have a gateway like that for international taxation, the gateway is Section 9, which talks about income deemed to accrue or earn in India. So this is the main first step, I should say, for to understand or to learn taxation from the income tax perspective. Today we have speakers from Mumbai, Rutvik Sanghvi and Ganesh Rajagopalan. On behalf of all of you and on behalf of the branch, I welcome both of you for this particular session and request Divya, the Secretary, or maybe the Vice Chairman, whoever is taking care of introducing the speaker and handing over the Thank you.
A very pleasant good evening to all the participants and to all the dignitaries on the panel. To give a brief introduction about today's speaker, we have CA Rutvik Sanghvi with us. He is a chartered accountant with more than 15 years of post-qualification experience and is a partner with Rashmin Sanghvi and Associates. He is involved in the firm's core international tax and foreign exchange regulatory advisory service areas, and his focus areas are inbound and outbound strategy, corporate and HNI investments, succession planning, as well as income tax and FEMA representation and compliance services. He presents regularly at various fora, including ICAF, BCAS, Chamber of Tax Consultants. He's co-authored and publication on digital taxation, a holistic view, published by Taxman along with his partners. He's also co-authored many other books. With this very brief introduction, I welcome you once again for today's program, sir.
Thank you.
Thank you. Ladies and gentlemen, we also have with us Ganesh Rajagopalan, sir. He is a chartered accountant by profession. He handles tax audits and litigation on income tax and indirect tax matters. He is a keen student of taxation. He was awarded Helter Self Medal for Standing Point, joined first in the paper Principles of International Taxation in the ADIT course conducted by Chartered Institute of Taxation, the United Kingdom in the year 2013. His academic research interests presently are in the areas of taxation, copyright law, and international trade laws. He has authored the book Taxation of Copyright Royalties in India, Interplay of Copyright Law and Income Tax, published in 2009. With this very brief introduction, I welcome you also for today's program, sir. Hearty welcome to both of you.
Thank you.
Thank you.
Thank you.
Thank you.
Over to you, sir.
Rutvik,
Yeah, Ganesh. Yeah,
should I
I
start?
think yes, exactly the way we.
Okay, fine.
Please.
Yeah, thank you, Bangalore branch of the SARC, in fact, the dignitaries who have chosen to invite us. Thank you for inviting us for this, to give a talk here and to lead this discussion, because this has been a very beneficial experience for us by way of revisiting all the old and established principles on international taxation and also finding out new ones and interpretations of the old ones. So this has been a good opportunity, a learning opportunity for us, and we thank you for this, for the same. What we have done is we are both of us, Rutvik and I, intend to take this session jointly for the simple reason that we would like to interject and interact on various issues when the other person is speaking. So what that helps us to keep ourselves on our toes. So you might find instances where we will be disagreeing with each other. So please don't take it as don't take it otherwise, because in international taxation you will find a lot of disagreements, which is why you look at any database of cases being reported. You will find many of them are largely most of them are on international taxation. That is actually arising because of disagreements. So we will disagree. So you can enjoy the disagreement, and also you can add your own points of view, because we will be opening up or we will be inviting questions periodically as and when we complete a particular portion of what we are speaking. The reason we do that is basically we can't keep all our questions for the end. By that time, you would lose interest, and probably you might lose the train of thought, which has given rise to that question in the first place. So, idea is to keep it interactive, but not so much that we break our flow too often. So, what we'll do is we'll have specific milestones, if I can call it that, where we'll invite questions, and if you have questions, you can put it on the chat box, and somebody can from the organizing team can pass on the questions to us. Now, as far as the subject proper is concerned, our topic is section 9, but I believe that even before we go to section 9, we have to understand the scope provisions in section 5. A lot of times when a query comes from a client, we end up jumping to section 9, whether this is royalty, whether this is FTAs, whether it is taxable. We start interpreting section 9. But I think a more important and more fundamental question we should ask is whether the income accrues in India, accrues or arises in India or not, or whether the income has been received in India or not. if you see a scope of total income for a non-resident, they are limited to income which is accruing or arising in India, income which is deemed to accrue or arise in India, which is as defined in Section 9, and income received in India or income deemed to be received in India. While for a resident, it doesn't really matter. His worldwide income is taxable, though Section 9 does not really delineate, or rather the earlier provisions of Section 9 do not really delineate between or differentiate between resident applicable, what is applicable to residents and what is applicable to non-residents. But unfortunately, that that discipline has been lost in the later amendments, where you will find a lot of references to non-residents alone. So whichever way, of course, we have to deal with whatever has been served to us. In whatever way the law has been enacted, we need to interpret the law and make sensible meaning out of it and advise clients accordingly. So now, when I look at a taxability for a non-resident, I do not jump directly to Section 9. I will have to go to Section 5, look at direct accrual and also maybe receipt in India, or the first receipt in India. And if I find that income is not directly accruing, or for that matter, income is not received in India for the first time, in that, then I will need to see whether income is deemed to accrue or arise in India. In that situation, I go to Section 9. So there will be some one or two examples. We'll take it up during the course of our of this session on this aspect. So I think we should keep that in mind. And also Section 5 and Section 9 are not on direct accrual and deemed accrual. Section 5 is a scope section. It includes deemed accrual. So Section 9 defines what is deemed accrual. So, or rather, it illustrates or gets all those various provisions which are spread out in all parts of the 1922 Act under one section, under Section 9, under the 1961 Act. So Section 5 and Section 9, there is no contradiction. Actually, they have to be read together, or rather, you read, if you want to understand what is deemed accrual, you need to read Section 9 and understand that meaning. You need to see and need to plug into the scope of total income, which includes deemed accrual. As far as the other points, which of course I think Rutvik would take, is basically between the connecting factors, is what they are called, which enables a sovereign nation to tax income. Now, we all know that residents are subject to worldwide income. Obviously, there has to be a connecting factor. The residents has to be a strong enough connecting factor to enable our country to tax us wherever the income is earned. That, as a residence-based connecting factor, is easy to understand. It is not very very complex or very abstract, so to say. It's a real connection and not an abstract connection. Let me put it like that. Now, you look at what would be the other type of connection. Would be basically if the income is sourced in our country. So the source becomes another connection. When I'm saying source, it is basically income is connected to our country. Let us say if somebody earns any income, having come here and worked that particular project, and they earn some income, if of course subject to all the rules of deemed accrual, what we'll discuss going forward, if that income can be connected to the territory of India, there is some nexus with the territory of India, that would be an adequate nexus for India to tax that income, even though the taxpayer is not a resident of India. So basically what we're talking about are residents and source-based connecting factors. Now these source-based connecting factors are available. One is directly accruing in India is of course a source factor. And deemed accrual is what we are going to discuss today under Section 9. Now whether those connecting factors are actually a bit stretched, or are they sufficiently real and not fanciful, that India can legitimately get a taxing right or appropriate a taxing right to tax such income, will be one of the points which we can discuss as and when we look at royalties, FTS, or for that matter, even business correction. And most importantly, the significant economic presence rules, which have the provisions which have been introduced recently. So with this background, I will ask Rutvik to take up the to carry forward the presentation.
Okay. First and foremost, many thanks to the organizers. And as Ganesh mentioned already, it has been an opportunity for us to again get into both an intense kind of study of the provisions, which we always love to go back to, as also go into some fresh new disagreements between both of us. So, which always adds to the learning. So, it is always good to go back to this topic. And thank you for the organizers to think us capable for doing so. Friends, as we already Ganesh has explained that, what are the two pillars of taxation, and I'm sure that you would have already gone through in the past few days on how the taxability arises in India. As we are today focusing mainly on the deemed accrual. So I will go forward to the part where, just to very briefly put it, that how incomes would be taxable in India. So here we are trying to tabulate it into a format where you can have a resident of India for whom the incomes which are sourced in India will remain fully taxable in India, and incomes which are sourced outside India would also be remain fully taxable in India, but with possible credit of taxes which are paid outside India. As far as a non-resident of India is concerned, his income sourced in India would be taxable in India, as Ganesh already pointed out. Your incomes which are sourced in India remain taxable whether irrespective of a residential status. However, there could be some double tax avoidance agreement relief which would exempt you from tax or lower your tax outgo. As far as incomes which are sourced outside India, definitely there will be no taxability in India. So this is a cross section of the two pillars on which which Ganesh just explained. And we also have the unique status of resident but not ordinarily resident in India. Again, those incomes which are sourced in India remain fully taxable in India, but the incomes which accrue or arise outside India, the incomes which are sourced outside India, within that, incomes which accrue or arise outside India, but is derived from a business controlled in India or a profession set up in India, do remain taxable in India. Apart from that, nothing else is taxable in India. So this is how the broad layout is of taxability in India. And the format in which, or the procedure or a process of taxation would go in this manner, that you have to first look at Section 5 of the Income Tax Act, which lays down this scope. The scope meaning that what do we consider as income sourced in India. Please bear in mind that Section 5 also refers to source and says from whatever source derived. That source is a separate meaning. It means that where the income arises from. Irrespective of that, incomes which accrues or arises in India, incomes which deemed to accrue or arise in India, incomes which are received in India, all these are considered to be sourced in India. That is what we mean by sourced in India. That is within the scope of income of India. And therefore, Section 5 is first and foremost to be seen whether that income accrues is or arises in India, or is received or deemed to be received in India, or it is supposed to be deemed to accrue or arise in India by way of Section 9. After that, Section 5 and Section 9, once you go through that, you would look at the relevant double tax avoidance agreement. Please bear in mind that today when we will be discussing, quite often we will be limiting or narrowing our discussion scope to Section 9 of the Income Tax Act, and sometimes we may not be referring to the double tax avoidance agreement implications. We will try to bring them wherever we can, but always bear in mind that when we that double tax avoidance agreement will kind of supersede these kind of taxation provisions, and therefore double tax avoidance agreement may give you certain reliefs. However, why this process of flow has been explained here is also to reason out that it need not be that every income is supposed to deem to occur or arise in India, and therefore you may first look at Section 5 and Section 9 and generally avoid an habit of jumping straight to a double tax avoidance agreement to understand what is the taxability of the income. So proceeding from here, we come to the first, the subject matter proper, the Section 9. And Section 9, as we all know, has been divided into several clauses. Section 911 refers to business connection, property, asset or source of income, transfer of capital asset. These are the kind of limbs which are there in Section 911. Then you have Section 912 dealing with salaries earned in India, and Section 913 for salaries payable by the government of India, and then so and so forth, which will be 914, 915, 916, 917, and now the new rule in place, which is the 918 for gifts. Now, this is where we will go in step by step to understand what are the implications for each of these provisions. First and foremost, Section 9 is a deeming provision. It must always be kept in mind that what does it deem exactly? It deems the place of accrual of income to be situated in India. What it means is that if there is an accrual of income which is happening outside India, Section 9 will deem that that place of accrual is frankly in India, even though in actuality, in reality, it is actually outside India. It will bring it back to India. It will consider that the place of accrual is actually deemed to be in India. However, it does not deem that the income to be earned where no income is earned. Please bear in mind there is no such presumption that something which is not income is considered to be income by Section 9. No, it does not deem taxability of income if income is not taxable. Say, so for example, you have certain incomes which are earned or accruing or deemed to accrue in India. However, those are exempt from tax in India. Therefore, you will have no taxability. Let us just take one small example is a gift if I give to my non-resident brother today. 918 now probably tries to ensnare those kind of incomes and say that if I am giving a gift from India to my brother who is outside India, who is a non-resident of India, even then Section 918 probably tries to bring to place that there would be a deemed accrual of such income in the hands of my brother, because otherwise under Section 56(2), whether probably you would be liable to tax in India. But because he is my brother and because there is a relation which is exempt from Sections 56 to 10, there would be no taxability. So please bear in mind that even if there is a deemed place of accrual in India, it need not always mean that income automatically becomes taxable. It also does not deem accrual by itself to occur if income is not accrued yet. Always keep in mind that income is to first accrue into the hands of the taxpayer. Only after that we come into the, and it has to accrue outside India is when we come into the place whether to see whether that income actually does it accrue, does it deem to have, does that place of accrual deem to be in India or not. So it is a limited kind of argument which Section 9 brings in. However, it is a huge implication because whatever is probably accruing outside India straight away is deemed to happen or accrue in India. It does not imply where the income is not taxable on the basis of accrual. Please bear in mind there are certain separate provisions for deemed to be received in India, and therefore this is not what we are talking about here. It is only on the basis of accrual which we are talking and whether that accrual is deemed to happen in India to that extent. Also, it does not apply where income already accrues in India. Always bear in mind that somehow what has happened is that because Section 9 is slightly more detailed, slightly giving the correct exact provisions of what is deemed to accrue or arise in India and what is not probably accruing or arising in India. Uh, uh, as tax practitioners, we probably come to a view that, okay, whatever is enshrined in Section 9 is the law, and Section 5, because it is bereft of all these kind of exact provisions, probably we miss out that what has happened exactly to the income. Has the income actually been accruing outside India? If not, if say for example the income is actually accruing within India, then probably Section 9 doesn't come into play. It is very clear that Section 9 will come into play only if Section 5 is first not satisfied, in the sense that under Section 5, if your income is accruing in India, then you don't need to approach Section 9. We will probably come to a certain case study to deal with this issue in more detail, and I'll park it for that moment. Obviously, it also, as I've explained, is not deemed, it does not apply where it is received or deemed to be received in India. So please bear in mind, even after your study of Section 9, these are the certain clauses which may still apply. Your deemed accrual rule fails to bring that accrual into India. Your income is accruing outside India. However, the income is received in India. You automatically get taxed. You do not get a relief under Section 9. You cannot say that even though received, my accrual happens outside India, therefore I will not give to tax. No, that may not help you. So please bear in mind that Section 9 overall has a very limited purpose of bringing the place of accrual to be in India where it is not. However, it does not apply in all cases, but wherever it applies, it has a major impact. And because it is detailed, there are so many such studies and interpretations which go into it, which we today will try to elaborate on. As I already mentioned, it has to be read with Section 5, the scope, and Section 6 of residence. And as Ganesh already explained, it effectively applies only to non-resident and in a limited manner to resident, but not ordinarily resident. But the language in general is not limited to non-residents. The reason it does not apply to residents is because obviously it covers both accrual and deemed accrual. Both incomes are always taxable in the case of a resident. Therefore, whether it falls under Section 5 or Section 9, a resident will always remain taxable. It generally expands the scope of taxable income in India, as we will probably see, because it is obviously deeming something to be happening in India when it actually is not. And as I already explained, it needs to be read with the DTAAs where applicable as per section 90, subsection 4. Please bear in mind that section 9, to my reading at least, was a very, very, it's kind of a very based on quite very good principles in mind, and has laid down certain principles where you can understand that why the deemed accrual takes place in India. Though they have not stated so, there could be, you could understand that there is a reason of a base erosion which is happening. There's a reason that why they have deemed that accrual to happen in India. We can understand those principles. And therefore, I would probably feel that it is one of the very well drafted provisions of the Income Tax Act. But with a caveat that it is probably only true till 2012, after which there have been several changes which have happened, some due to the judgments to counter certain judgments, and some to just make a general expansion just when they felt that no, we need to tax even more. Unfortunately, the languages after that there are not exactly, I would put it this way, that not exactly with clarity in mind. Especially when we look at the provisions of SEP, which Ganesh and I will deal with in detail, there is much left to be desired in a ways. Coming to section 911 proper, what does it say? And I've tried to break up the section here. It says that the following income shall be deemed to accrue or arise in India. All income accruing or arising, whether directly or indirectly, through or from any business connection in India, or through or from any property in India, or through or from any asset or source of income in India, or through the transfer of a capital asset situated in India. Uh, we all know that through or from any property in India is kind of simple to understand. Through or from any asset or source of income in India is also not too much of debate there. The two major debates are always surrounding towards business connection in India, the first limb, and the last limb through the transfer of a capital asset situated in India, which after the Supreme Court judgment in Vodafone BV has brought in a lot of changes. Therefore, we will probably focus more on these two limbs as we go forward. Business connection, what does it do? It deems income to accrue in India even though it may not, if and only if there is a place of if and only if there is a business connection. So it deems the income or the place of accrual to happen in India because there is a business connection in India. The problem here lies is that business connection has not been defined, and it also can apply to income other than business income, meaning that professional income can also get covered. The newest rule which is now coming to play is that the SEP, the significant economic presence, is now deemed to be a business connection in India. This is a kind of landmark change what has happened recently, and we will deal with it more in detail as we go forward. What does business connection mean? It means that taxation only when the business is done in India. Section 9 extends this to business done with India too. So let me put it again. What generally it happens is that under the Income Tax Act, the income tax liability is there when there is a business done within India. However, Section 9 is trying to bring into place where probably the activities of that business are happening outside India. But because there is a business connection, they are saying that no, there are certain incomes which, even though the business is done with India and not within India, still we will try to bring it to tax as per Section 9. And business connection, though there is no definition, has been explained by court rulings where it says then main features are that it all depends on the relationship between the non-resident's business and some activity in India. That is the relationship which is called as a business connection. It is not simply any connection, business connection. It is not just business, it is there has to be a connection. It's a term which is not, if you would notice, outside of Section 9, it has rarely been used in the whole of the Income Tax Act. The reason being that it refers to the connection which a non-resident would have to some activity which actually takes place in India. Without there being any of those activities, probably there would be no business connection. That has to be borne in mind, except for now what has come by way of significant economic presence, which has upset the whole apple cart of understanding of business connection till date. So we will, as I again explained to you, as I mentioned to you earlier, we will deal with it in detail later. But right now what we have to focus on is that what does business connection mean? It means that there has to be a relationship between the non-resident's activity outside India and with some activity in India. It predicates continuity. It is not one-off or casual transactions. It means that there has to be a continuous kind of activity which happens in India. It is a real and intimate relationship between the activity outside India and the activity in India. And the relationship between the two, that relationship, that connection is what exactly contributes to the earning of the income by the non-resident. Not just having a relation, but that relation must also contribute to that income. It should not be just that I have an agent in India, but I must see to it, or it's not just having an agent in India, but also that that agent is contributing to the income of the non-resident is what would lead to a proper uh, application of business connection. Occasional activity is not covered, as I already explained, and it is readily established if there exists an element of agency between the non-resident and India. This we will go into further details later on. These features are, as such explained by the R.D. Agarwal and by the decision of the Supreme Court in R.D. Agarwal and Company, but it still remains a subjective concept. It needs to be looked at and screened through fact pattern of every case individually. There can be no broad general proposition made that no business connection applies it to certain business models every time. No, it does not. As we will go further, we will see that in most cases, it will depend frankly on the facts of the case, whether the business connection exists, even though it may be that two cases look very, very similar to each other. Certain examples of business connections, the straightforward examples are the branch in India, the factory in India, having an agent in India, again, but in certain circumstances, and a subsidiary in India, again, in certain cases. Please bear in mind, section 9, the business connection principles are kind of akin to a permanent establishment threshold, which is there under the double tax avoidance agreements. I understand probably in the next couple of days, either probably tomorrow or the day after, you are going to deal with permanent establishment. In a ways, the idea of both is somewhere similar. They are trying to bring to tax in India, something which happens in India. However, there are certain differences also, certain nuances also. While we may not go into too much detail, the point to be noted is that even if you have a business connection in India, you could very well make out that there is no permanent establishment in India, which is the bare minimum threshold for a business income to be taxed within India as per the treaties. And if that be the case, if the treaties, as per the treaty, the business permanent establishment is not situated in India, or there is no permanent establishment in India, your business income would not remain taxable. So please bear in mind before you go forward and say that no, my income is taxable. Yes, it may be taxable by the way of business connection. You may still apply the permanent establishment threshold. The reverse, as I explained earlier, is also true, that you may come to sometimes a conclusion that, oh, I have a permanent establishment in India. I do have an office in India. However, in certain circumstances, you may make out that no, I do not have a business connection in India. There are such cases, and we will come to in as we go forward. The first exception, and the reason why I say that, there could be cases where you would have a permanent establishment in India as per the treaty that the India has with that relevant country. However, as per business connection, you would be exempted from tax. And those are the exceptions to business connection. We have understood business connection. Let us now go into the exceptions. And those exceptions are what will rule the roost. And therefore, you must bear in mind that these exceptions are becoming very important. Let us take an example that the first exception is the purchase for exports. No income shall be deemed to accrue from operations confined to the purchase of goods in India for the purpose of export. This is a broad ruling, broad kind of provision. Earlier, there used to be a proviso which said that if there was an office in India, or if the processing of those goods happened in India, which were then meant for export, they would not be covered within this exclusion. That proviso has actually been removed so as to broaden the provisions, and which means in substance is that they are trying to cover a broader outlook towards purchase of exports for the purpose of export, purchase of goods for the purpose of export. They really want to exempt those activities from creating a business connection in India. But then what happens to certain cases about purchases which are for sale within India? Definitely it would not get covered because it's not for the purpose of export. What happens when you purchase operations are in India, but the purchase of goods happens from outside India? So these are some details which we will come into as we go forward. I have put in certain examples which we can discuss. Especially, you should always note that purchase of goods should ideally logically also cover purchase of services. They therefore should also become exempt. However, there is no such specific exemption given under the Act. Let us look at the first example, purchase of goods for the purpose of export. here we have a foreign purchaser. The foreign purchaser is, he is actually getting suppliers. He's having suppliers in India from whom he is getting paying them and getting goods exported for the purpose of selling them to foreign customers. In which case, he is a non-resident who is actually purchasing the goods for the purpose of export. Clear? No income shall be deemed to accrue from operations confined to purchase of goods in India for the purpose of export. This is exactly what is falling in line with this, and therefore it's very well covered. We have the cases of IKEA Trading, Nike Inc., Tesco International Sourcing, Columbia Sportswear, several rulings which clearly hold that if there is a purchase of goods for the purpose of export from India, therefore there is no liability to tax in India. It could be that a foreign purchaser has a business connection in India. Even then, there would be no liability to tax in India. But let us twist this example a little bit. Now let us for a moment consider that there is a foreign intermediary. The intermediary is not the person who is purchasing the goods. The foreign intermediary has a branch in India. What does that branch do? It provides several supply chain management services. By supply chain management services, it could range from selecting a supplier, selecting a vendor, selecting whether that manufacturing capacity is in line with what they exactly want, selecting whether the quality or monitoring the quality of the goods which are produced, finding out all those services. These are all services connected to the purchase of goods. However, not exactly the purchase of goods. The intermediary or its branch will not enter into the purchase of goods. The foreign customers will directly purchase from the suppliers in India. The goods will get exported to them directly between both of them. Foreign intermediary will only provide quality control services and within India certain supply chain management services. So these are the kind of services which are provided. Now let us look at the wording again. What does it say? It says no income shall be deemed to accrue from operations confined to purchase of goods in India for the purpose of export. So what does this mean? In plain reading, it seems to me that yes, it is only for the purchase of goods, nothing else. I don't consider these services which have happened in India to be liable to tax within India. For this, we have certain case laws, Columbia Mondial Orient Limited and the Columbia Sportswear Company, the AR decision. Obviously, that has been reversed by the High Court, but there are certain nuances which have been discussed within the AR ruling in further detail or more detail than the High Court decision. But what my point here is that in certain cases, what they have clearly said is that these kind of services are also nothing but for towards the purchase of goods and hence included and hence covered in the under explanation 1B to section 911. The exception is given and therefore there is no taxability within India. Please bear in mind that this is highly litigative. There have been several cases for which this courts have fought and they have gone into the nitty-gritties and in some cases said that yes, there is a connection and therefore there is no requirement. The activities made or done in India by the liaison office or the branch in India are nothing but towards the purchase of goods and therefore they are also covered even though the purchase of goods may not directly happen. This while it was put in place, there is a certain difference which can happen, which is where you have the foreign purchaser, the foreign purchaser in this case who is purchasing the goods, he is a non-resident. But what happens in that is that the purchase orders are not only accepted but also executed in India. And this is a unique case where what is happening is that probably there are certain activities which are happening within India and then you're trying to claim an exemption from section 9.1 explanation 1B. So now what happens is that when you're executing certain contracts in India, then your income is actually received or is actually accrued in India, then then you don't go to section 9. If you remember just a few slides back, I explained how section 5 has to be first looked at, then you go to section 9. Then does it mean that if accrual of income happens in India, then why do I go to section 9? A non-resident's income definitely gets accrued in India, then you don't go to section 9. This is what has been brought out by both these decisions of Mushtaq Ahmed and Mondial Orient. And I believe that Ganesh wanted to add here. So Ganesh, can you please share your views also?
Yeah. So what my thought is, when you look at this exception which is contained in explanation 1B, it is for the purposes of that clause, which is 911, which contains a business connection. It cannot be interpreted as a standard as a general rule for non-taxability of purchase operations in India.
Very good point.
So
Yeah.
first, we have to determine whether there is a business connection, and because there is a business connection, there is a purchase operations happening in India. In that case, you can get the export. You can get the exemption, which is available under 1B. But you look at Mondial export, what happened? In Mondial, you had basically, Mondial was a non-resident. It had operations in India of doing purchase support. It was actually doing the purchasing activity. It was operations for various non-resident customers of Mondial. So various non-resident customers of Mondial wanted somebody to do the licensing and sourcing of their goods in India. Mondial offered those services to those non-residents. Now, the applicability of explanation 1B, which is exemption for purchase for exports, will be available to the non-resident clients of Mondial and not to Mondial itself. Mondial is in India carrying on the operations relating to purchasing or whatever licensing work, whatever activity it was doing. It was an operations in India. So explanation 1B cannot be targeted at the intermediary who's doing this activity in India. It is targeted at the non-resident who gets benefited from these activities and whose income falls out of the tax net. So you're a non-resident customer of Mondial who is abroad, who is earning income by selling, let's say, selling those goods which it exports from India, which has been sourced by Mondial. In such a case, that income, a portion of it could get dragged to the tax net in India, because if the exemption of 1B was not available, that non-resident customer of Mondial. When we are looking at, but then what has happened is Karnataka High Court unfortunately went on 1B as an absolute exemption available for purchasing activity. There, of course, there are statements that it doesn't say it has to be purchasing by yourself, as long as purchasing for yourself, as long as you're doing purchasing activity. Or that there is no quarrel with that logic. But the point is, we are not even determined business connection for Mondial. There is no business connection for Mondial. So we have a problem. So really speaking, it has no applicability for Mondial, but unfortunately, Karnataka High Court applied it. So this comes out in your Mushtaq Ahmad's case, which is an AR ruling, where it was basically a non-resident, as an NRI, he had a jewelry business abroad. He had a store in India, whereby he was only sourcing jewelry material for exports and claimed this exemption, saying that my activity is only purchasing for exports. So you give me this exemption, I am not taxable in India. AR said nothing doing. Why are we even looking at Section 9? You are doing operations in India. It is covered under Section 5, which I believe is a decision which I would lean towards, rather than a Mondial decision, a blanket exemption for purchase for exports.
Yeah, I think I would put it this way, that the exception provided by explanation 1B, as Ganesh exactly pointed out, is for the business connection, and therefore under Section 911, it does not mean that Section 5 also gets exempted. However, there have been certain rulings where they say that no, Section 5 says subject to other provisions of the Act. Please, I would probably not subscribe to the view that Section 5, by using the phrase subject to the other provisions of the Act, gets limited by Section 9. Not at all. Section 5 has clear principles laid down that what is considered within the scope of taxability in India, and if income accrues in India, if the rises in India, if the income is received in India, it remains taxable in India, irrespective of what Section 9 says. I think that is what must be borne in mind, and this is what the decision kind of brings that out. Just that what is the differentiating factor here? Ganesh, as you mentioned, that there is in this particular facts of the case, you are saying that yes, Section 5, yes, income accrues, definitely taxable. But then what is different from Mushtaq Ahmad to, say, for example, a Nike Inc. or say a Columbia Sportswear? where is that difference where we are saying that no, other than that, the other cases section 911 applies and therefore the exception also probably will be exercised and therefore there may be no taxability. Would you like to elaborate on that? Because otherwise, it becomes a bit confusing that, okay, why
No,
we are
you
having
take
one case where,
yeah.
it
So, but
applies. Yeah.
if the decision is that if I have a liaison office in India, I do the sourcing for a Nike or Adidas or Columbia Sportswear, and I export, those goods are exported directly by the suppliers in India to Nike abroad, let us say. The question is, I do have operations in India, right? On that operations, I am not paying tax on on that portion of operations. I'm not paying any tax, basically because the operations are limited to maybe a commission activity or whatever. But
Perfect.
if you look at two old decisions on this, Anglo-French Textiles and Ahmad Bhai Umar Bhai, they are two old decisions where they upheld the principle of apportionment of income, dehors section 42. This is the section 9 now, under the 1922 Act. Dehors means basically they said that this apportionment what we are doing between operation and operations outside, operations within the tax territory and operations without the taxable territory is based on normal accounting principles. It is not based on business correction. So basically they said there are some activity happening within the taxable territory and some without the taxable territory. To say that the income accrues only when the sales takes place outside the taxable territory. So not when, where the sales takes place outside the taxable territory. So there is no income accruing or arising in India. To say that would be incorrect. So even though the sales takes place outside India and the income is earned by the non-resident, the various operations of the non-residents have contributed towards the sale, and apportioning profits, which is ultimately realized when it is sold, but apportioning the profits to the various operations is a normal accounting principle. Nobody needs to be surprised about it. So Anglo-French Textiles and Ahmad Bhai Umar Bhai have said this. Now, I have operations in India and I have operations outside India. I earn income when I sell the goods outside India. Now, question is, for the operations in India, do I need to attribute income or not? Now, what 1B says, if there's a business correction, you are exempted from attributing or apportioning income to the Indian operations if their operations are confined to only purchase of goods for export. There is no such exemption generally in section 5.
Correct. You're right.
See, now you reconcile the problem.
I agree. So
one is we can take the case laws and apply it. That's fine. But here we are learning the subject. So I thought that this proposition needs to be brought out. Otherwise, we are only glossing for the unsaid controversies which are underlying these case laws.
Understood. Somewhere I have kind of obviously not reached a conclusion, but probably seems to be that otherwise, if for example there was as you correctly said, as per Ahmed Bhai, Umar Bhai, as per Anglo-French, every operation is equally important in a business. And none of the operations in a frankly can operate without all of the operations. In the sense, business cannot operate with in isolation and having only certain operations. So purchase itself is also an equally important operation, therefore leading to an apportionment of income. Whether there would be somewhere you can say an accrual also taking place, I would put it this way, probably in my view, that every purchase by an exporter from India, as such, in my view, may not directly lead to an accrual of income in India, but it may lead to apportionment of income in India if there is a business connection or if there is an actual accrual anyways taking place in India. Actual accrual meaning that purchase activities can happen in several manners. You can have somebody as your agent in India, you can have your own liaison office in India, or you can, in probably Mushtaq Ahmed's kind of case, having your own people and having those executions of those contracts happening in India, the payment happening in India, the receipt of those funds happening in India, which probably leads to the fact that there is actually an accrual in India. and therefore you don't go forward to Section 9. Whereas in the case of other people, probably if the invoice raising happens in India, but the payment and everything happens outside India or from outside India, probably I'm not so sure whether we can try to say that there is a pure export of goods. Primarily speaking, while yes, important that there is a certain operation which is executed in India, unless there is a business connection, probably accrual may not happen. If there is a business connection, and if that business connections operations are confined to the purchase of goods in India for the purpose of export, then again you will be exempted from attributing any income towards those operations. Is where I would probably try to bring out a probably I would pay a conciliatory approach to all these various decisions. Otherwise, upset the apple cart as so as to speak of even Supreme Court rulings. If we go by the fact that yes, every purchase operation is accrual of income, and that is something which obviously is yeah.
So I'll refer to one judgment of the Supreme Court,
Yeah.
CAT versus Ashok Bhai Chiman Bhai, where the citation I'll give you it again. So, citation is 1965 56 ITR 42. Now there it was held in a business, profits do not accrue from transaction by transaction. Profit accrue at year when you do a profit and loss, when you do accounts, the profit accrues only at the year end. So basically, I don't need to look at a transaction by transaction approach to identify accrual in a business. So if you keep that in mind and then revisit or whatever we discussed about explanation 1B, basically what we're talking about is I derive profits from my business abroad. Some part of the operations of the business are in India. That I need to apportion the profits which say accrue to me at the year end to the Indian operations as well. Now, only question is, if those operations are done by me directly, there is no confusion. I need to simply apportion those profits, which you find the banks, for instance, branches of foreign banks are paying taxes in India. There is a confusion, right? So basically, if I have operations in India, it is direct accrual. I don't need to look at Section 9 at all. Now, why do I need to look Section 9 is when these operations are not done by me and I do not have a presence here. There is somebody else from whom I do these operations who end up amounting to a business connection. Like these suppliers, what is there on the slide.
Correct.
These suppliers in India would be my business connection because I regularly buy from them. I have a long-term contract of supply from them, which implies the suppliers could become business connection. And if they become business connection, they are paying taxes on their profits anyway in India, no problems. We are not on that at all. We are not on the supplier's taxability. We are on the foreign purchasers taxability vis-a-vis the goods which it had earned or the profits which to the extent the business connection which the suppliers has contributed towards his profits outside India.
Perfect. Yeah.
But we are on first principles. Please, is not to confuse anyone or confound anything. We are on first principles. In these aspects, we have been reflecting for last 15 years. Still, we are continuing to reflect. So we are just putting this as a thought, to provoke thought. That is not something we simply look at a case law and simply apply the case law. Case law could be very well wrong, and a smart assessing officer can distinguish those case laws and take our client to trouble.
Let us bring another kind of such situation. Here in this case, there is a foreign company which has an Indian liaison office, and the liaison office gives certain activities related to the purchase function, as we all discussed, similar to seeking out the suppliers, doing some quality control. But that's all. They provide only those services, while the goods are exported by the suppliers in India directly to the foreign company. The twist in this example is that the Indian liaison office does not do it only for the suppliers in India. It also provides similar services for suppliers outside India, who also in a way directly export the goods from outside India to the foreign company. Frankly speaking, there should be no kind of taxability in India at all. This is a supply of goods within two foreign countries. The problem lies here is, what does the exemption for the business connection, which is now in India, formed by way of the Indian liaison office, what does it say? It says that no income shall be deemed to accrue from operations confined to purchase of goods in India for the purpose of export. So please bear in mind that if you have a business connection in India, which caters not only to purchase of goods for the purpose of export only from India, but also from other countries, you could be brought to books by saying that you do not fulfill the exemption provided by explanation clause 1B. You will have to probably put in that no, only those activities which are limited to purchase of goods from India, meaning suppliers from India, only that activities remain out of the purview of taxability in India as per section 911, but not about the activities which are conducted for the suppliers outside India, for which the liaison office is providing certain services, by which it means that totally foreign transactions, totally transactions done outside India could still lead to certain connection in India, could lead to certain accrual of income in India for the non-resident, because the exemption is not provided for export of goods which are happening from outside India. Only exemption is for export of goods from India. This is a point which should, a lot of people miss out, because they just say purchase of goods from export. So man, I am covered. No, that is not the case. It is purchase of goods from export from within India. Columbia Sportswear, the AAR ruling did refer to this particular issue. They had that time a liaison office which was not just doing it for services for exports from India, but also from Egypt and Bangladesh. The point is that the AR definitely held that as one of the reasons why it said that there is a business connection in India, and that exception provided by explanation clause 1B is not available to Columbia Sportswear. One of the reasons was that because they were also providing services to Egypt from exports from Egypt and Bangladesh. Please bear in mind this decision has then been reversed by the Karnataka High Court decision, where it seems that this kind of fact pattern has not been gone into. The reading of the decision is, you can make out that they have not frankly touched upon this particular issue. Probably the Revenues Council has not pointed out these particular issues. We don't know for what reason, but obviously it was held that there is a purchase of goods for export from India, and therefore the exception applies. It was in favor of the assessee. But please bear in mind that, as Ganesh just now pointed out, that we may not take decisions by these higher authorities also as gospel truth. We may look into them and we see that whether these have been actually correctly held, or at least they have considered all the issues or not. Because any smart officer tomorrow will always say that, yes, I have Columbia Sportswear AI, that in principle they have reversed the decision, but a fact pattern which is similar can still be, adjusted to, and definitely it does not fall within the language of the exception. So this is what we wanted to bring out here. Ganesh, anything to add, or should I move on?
No, please carry on.
Yeah.
Yeah,
Now,
please carry on. Please carry on.
Yeah. There are certain other exceptions which I will not go much into detail, because these are particularly with respect to certain types of activities or industries which happen. Purchase of goods for export from India could be probably very well be for several industries and all. These are specific that news agency, for a news agency, for shooting of cinematographic films in India. There are conditions attached to each. The mining of diamonds in India. So these are the specific exceptions given. I'm not going into detail. It's probably not too much to deal with in this scenario right now. Coming to the major other clause which brings in a business connection is a dependent agent. And how have they framed the whole clause? They have framed the whole clause where it says that under explanation 2, it says that it is hereby declared that business connection shall include any business activity carried out through a person who, acting on behalf of the non-resident, so essentially an agent, has and habitually exercises in India an authority to conclude contracts on behalf of the non-resident, or habitually concludes contracts, or habitually plays a principal role leading to conclusion of contracts by that non-resident. And there are certain conditions where that would apply. In certain cases, it says it has no such authority. The agent has no such authority, but habitually maintains in India stock of goods or merchandise from which he regularly delivers goods. Or C, habitually secures orders in India mainly or wholly for the non-resident, or for that non-resident and other non-residents, controlled by, or subject to the same control as that non-resident. They have tried to bring in a group kind of, if the person split the transactions, then also a group of companies, if they have a certain agent in India, it would still get covered within this provision. This provision, please bear in mind, has changed from Finance Act 2018. It was earlier a simple clause which say that it has and habitually exercises in India an authority to conclude contracts on behalf of the non-resident unless his activities are limited to the purchase of goods or merchandise for the non-resident. So this was what was simply stated earlier. The Finance Act 2018 clause, Finance Act 2018 replaced this clause by bringing in this whole set of provisions, a new provision. Why was this provisions brought in? Because this was in line with the multilateral instrument and the BAP section plan 7. I'm sure you will be hearing much more about it as the days progress. The whole idea here was that there were certain kind of contracts which were not getting taxed by certain kind of agency contracts which are not getting taxed, and something which was a mere conclusion of contracts on behalf of non-resident. From that, it has now gone ahead and included habitual conclusion of contracts and even habitually playing a leading role to the conclusion of contracts. Please bear in mind there has been a sea change in the provision of dependent agent, and while this provision was brought in by the web section plan for cornering certain contracts which frankly do not happen in India, the commissioner kind of arrangements which are not there in India. However, the reading or the wording of the clause has now widened it for everyone, and the agency clause therefore gets widened quite a lot. As I mentioned, it was applicable only for commissioner agent arrangements, which is not a concept which is prevalent under common law kind of common laws which is followed by India. Also bear in mind that this exclusion which was there under the older provision, if you notice here, older clause had an exception which said unless his activities are limited to the purchase of goods or merchandise for the non-resident. This was a very, very broad exception for a dependent agent. Please bear in mind. Unless his activities are limited to the purchase of goods or merchandise for the non-resident, here there is no exclusion or there is no condition that the goods have to be purchased for the purpose of export. There is no condition that the goods have to be purchased for the purpose of export from India, or rather it is not for the purchase of goods in India for the purpose of export. Those conditions are not there, what we just notice in explanation 1B. Unfortunately, while trying to amend this provision, this exclusion also has been removed and this exclusion has gone out. It now says explanation 1B is now the only exception which will now rule. This particular limb of explanation 2 has now gone forever. So you would not have that possibility to refer to that. At the same time, incomes due to activities of a truly independent agent are not deemed to accrue in India. How has that come out? That there is an exception to explanation 2, which says that it shall not include any business activity carried out through a broker, general commission agent, or any other agent having an independent status. If such broker, general commission agent, or any other agent having an independent status is acting in the ordinary course of his business. In a sense, income due to activities of dependent agent are deemed to accrue in India. This clause is not there, obviously, under section 911. They are not termed it as dependent agent. I am only drawing a parallel with what is there under Article 5 of the treaties. However, please bear in mind that an independent agent is largely not covered. It is only a dependent agent. At the end of the day, only the income which is attributable to the operations carried out in India are deemed to accrue or arise in India, not more. We will not deal with attribution right now. We will first finish off the business connection issues. At the same time, as I explained, that an independent agent, when he works on behalf of a principal non-resident and other non-residents, in the sense that where you have a independent agent who is kind of working for more than one, then you would call him an independent agent. However, if that person is working for not just a principal non-resident, but even other non-residents who are at the end of the day part of the same group, either by way of those companies being controlled by the principal non-resident, or being subject to the same controlling interest, or having the controlling interest by the principal non-resident. In that kind of a case, they would not be deemed to be an independent agent. That please bear in mind. They have tried to bring in a group dynamic kind of exclusion to the independent agent exclusion to the dependent agent explanation. So please bear those in mind. You have an explanation which brings in something more to business connection. Then you have an exception, which is explanation of deemed agent, dependent agent. Then you have an exclusion to that of independent agent. But then you have an exclusion to the exclusion where you have said that, okay, an independent agent who caters only to a certain controlled group of non-residents, then again, you will be out of this exclusion. Now, coming to the domestic attribution principle, please bear in mind that this is the attribution principle which governs how much income is taxable in India due to a business connection. Very, very important provision. It says that income attributable only to operations carried out in India is deemed to accrue in India. And what does expression 1A put up? Expression 1A says, in the case of a business of which all the operations are not carried out in India, the income of the business deemed under this clause to accrue or arise in India shall be only such part of the income as is reasonably attributable to the operations carried out in India. This brings in the attribution principle. You do not need to say that, no, just because one of my operations in India, the whole of my income gets taxed. No, it is only to the extent that the operations are carried out in India. Ganesh, you would like to add here any points?
No, I think you carry on. I think we have covered these aspects when we discussed 1P also. So I think
Yes. Okay. Just for the participants, please note that we have covered section 9 also in detail when we had taken up the Revisit Income Tax Act program, which happened a couple of months back with same Bengaluru branch of the SIRC of ICI. And there are also some details which will go, and probably participants who are common may probably feel that there is a kind of repetition, but honestly, we cannot avoid those repetitions because both deal with the same topic of section 9, but we have tried to go forward in this particular presentation by covering certain more nuances which are very relevant for international taxation. In that context, if there is any explanation further you need, you can always go back to that presentation where we dealt with more in detail on section 9 itself. Sir, certain other points which one must note, Circular 23 of 1969, a very beautiful circular which laid down certain exceptions and certain norms of how these principles are to be considered, how a business connection is to be understood. Sadly, it has been withdrawn in 2009. But to my view, at the end of the day, the principles still hold good. They are, as you know what Ganesh says, they are first principles. They don't. It was not as if they are giving some relief to certain industry. No, it was not. It was actually enshrining a lot of decisions which had happened in the past and was giving certain logical relaxations or certain logical clarity to the provisions of business connection. It can still be referred to. How far, if you try to take recourse to it during litigation, is doubtful. At the end of the day, the principles still remain valid. You must also bear in mind that when you look at, say, Article 5, permanent establishment under double tax avoidance agreements, there is a clause for force of attraction. What it means is that if, say, for example, a company, a non-resident has a permanent establishment in India, and it is not selling goods or services through that permanent establishment, but directly to its customers in India, then the force of attraction grabs those activities or incomes which are attributable to those separate activities also, or sales activities also, to the permanent establishment in India. However, the scope under Income Tax Act is narrower. Please bear in mind, Income Tax Act, what you will say that a non-resident has a business connection in India, and therefore a business connection. What is the income rule, attribution rule? As we already discussed here, it is only attributable to the operations carried out in India. Probably the scope of attribution as per the Act is actually narrower than what is actually enshrined by the double tax avoidance agreements. This was brought out by Roxanne OI and quite a few decisions which came, following this. So please bear in mind, as we discussed earlier also, while double tax avoidance agreements definitely bring a cap to taxability in India, there could be instances where actually the Income Tax Act is far more beneficial than even the double tax avoidance agreements, and therefore one must bear in mind that both are read judiciously and both are applied properly. We already discussed business connection includes professional connection also, but when you go under tax treaty, then you look at the fixed base Article 14, and then there is generally a number of days threshold ranging from 90 days to sometimes 180 days, without which there would not be a fixed base. A fixed base would then mean something very similar to a permanent establishment when you look at something which is not a professional services. So these are the kind of taxability for professional fees. Finally, business connection, one of the most important questions which keep coming as far as section 9 is concerned is about a foreign agent. A foreign agent of an Indian exporter who operates in his own foreign country or outside India and has no part of his income which accrues or arises in India. What happens in those cases are that generally that income is remitted directly to him, and it is not considered to be received by him in India or on his behalf in India. in my view, this is very clear that such an agent is not liable to Indian income tax. There are certain circulars going back to 1953, and there are obviously Supreme Court decisions also. Toshuku CIT versus Toshuku 125 ITR 525 clearly lays down the principles. Unfortunately, what has happened is that in some cases, you may bear in mind that there is not a mere agency or more a near commission income which is earned. The character of income becomes very, very important. And therefore, a drafting of an agreement between the resident and the non-resident agent is very, very important. What are the scope of services to be covered for the non-resident agent? Please bear in mind that if you have services like managerial services, services where you are actually providing, something of a technical service, then definitely it may fall under the fees for technical services, a broader clause, a much broader clause, which obviously Ganesh will be taking in detail later on. But what we must bear in mind is that if will then come whether the definition of fees for technical services and become squarely taxable in India. If that's the fact of the case, then well and good. But we have come across cases where actually the agent is nothing but a pure marketing agent. He only goes and finds out customers for the Indian seller. And in those cases, agreement is somehow drafted in a very broad manner to probably try to show that, oh yes, he is doing so many services, or just for the fact that that is a probably a standard template which has been taken from somewhere else. Doing that is a big risk, because if those services are actually not being offered by the agent, the tax officer will probably still look at it that your agreement says so that he is providing you managerial services, he is providing you technical services. Why should I not apply FTS article? Then in such a case, your only recourse would be then to double tax avoidance agreements. The double tax avoidance agreements, if for example, something like an UAE treaty where you do not have an FTS clause, are you going back to the permanent establishment threshold and therefore getting out? Then those are the things which you may consider. However, otherwise, the language of the agreement and the actual fact pattern of the agent's activities which are happening outside India are very important. But if they are limited to just the market, just finding out buyers for the Indian seller, they're pure business activities, nothing in technical or fee or managerial in nature. Definitely, there is no tax liability in India just because the person is situated or the seller is in India. Then coming to, before jump into SEP, because this is where we are diverging from business connection. The definitions are actually kind of very broader than what our normal understanding of business connection is. If there are any questions, Ganesh, should we take questions at this moment, or you want to take it afterwards?
We should take questions now, because like we have done quite a bit of we have covered quite a large portion of section 9.
Yeah.
If there are questions,
because section SEP will then bring us into a different tangent. So let us,
yeah. So if there are questions, people can either put down the chat box or whatever. Mr. Shetty.
There are two questions in the Q&A, sir. Can you see that?
Yeah. One second.
I can see the chat box.
Q&A, I'm not able to open.
Yeah.
Got it, yeah.
Okay. Excuse me. Yeah, I think the first question is related to whether the Indian subsidiary. I'm not so clear what exactly is, one US company is Indian subsidiary. Indian subsidiary does not have any income or revenue in India. All costs are borne by US parent. Is the money provided by parent for costs treated as deemed revenue in India, and is it taxable? Since it is startup developing a service IT product, there is no service or product from Indian subsidiary to the parent.
So that will depend on
Rutvik. Services. Yes. Yeah. Sorry.
Rutvik, I think this will, what he's asking is basically the foreign parent. The parent is funding the Indian subsidiary.
Yeah.
Then whether it will be income of the Indian subsidiary is a question, right?
Correct. Yeah, that seems to be the case. Correct. So in my understanding,
It
if
was
it is,
deemed revenue in India.
yeah, correct.
Yeah, Rutvik, go ahead.
No, so in my understanding, generally speaking, when there is a subsidiary in India, there is a contract of services which is entered into between the Indian subsidiary and the US parent. The contract of services is what entitles the US company to fund or to pay for those services which the Indian company is actually providing to the US holdco. And in that kind of a scenario, the markup, or either what you would say is that whatever is above the cost that is actually earned by the Indian company in India would be taxable squarely in India. But the whole of the amount need not be. Because at the end of the day, you will enter into a profit and loss account. You will say that what is received from the US company, what is actually expensed out by you, and then finally what is the net profit remains taxable. I hope I am understanding it correctly. If that's the case, only the profit part of it should be taxed, which is generally the, in a cost plus scenario, it will be the plus of it, what is exactly added to the cost as far as the Indian subsidiary is concerned. Sorry, Ganesh, do you feel that answers, or do we need
Yeah,
to?
fine. That's good enough. Yeah, I think let's go to the next one.
How double taxation is taken care in the following scenario? Resident Indian has invested in US LLC company, and LLC is distributing the other company's shares. Yes, distributing the other company's shares it is holding. I don't think this is dealing with business connection. If you don't mind, we can kind of let the other speakers who are dealing with this issue take it up.
Yeah, correct.
If the non-resident agent also does clearing and installation support services, whether the income would be taxable. A non-resident agent or an Indian agent of a non-resident? I'm not clear.
So let us read it as agent of non-resident.
Yeah, exactly. If the non-residence agent also does clearing and installation support services, whether his income would be taxable. So this is where we are going into the gray area where certain decisions have held that support services also for the purpose of purchase of exports. I'm believing that this is where the query is towards. And if that be the case, and for the purchase of goods for the purpose of export, if these are support services, there are several decisions which are held in favor of the taxpayer, saying that all that is considered as purchase of goods for the purpose of export. But as Ganesh already pointed out, that there could be a chance that when you are providing all these kind of services, your income actually, very frankly, is accruing in India. And honestly, there are a few decisions which have pointed out that it is only confined. Your exception is only confined to the purchase of goods, not to anything else. But again, as we discussed, there are quite a few High Court decisions which have held that even connected services will be covered within the purchase of goods for the purpose of export. Whether having an affiliated entity means that there is a permanent establishment in India or business connection in India. Not necessarily. An affiliated entity, by which I don't know whether you mean to say that a subsidiary kind of relationship or a branch. So see, very frankly, there would be obviously a business connection if you have a presence of the non-resident in India in whatever form. But whether that business connection leads to income liable to tax in India is a different matter altogether. So if that business connection, or for example, that office is providing services, certain support services, certain liaison services, which are for which it is getting paid, and for that which it is paying tax in India, then need not be that there is a taxability in India for the non-resident if those are the only services which are provided. But yes, is there a permanent establishment or a business connection? I would probably believe so, except for the fact that every subsidiary does not become a permanent establishment. Please bear in mind that a subsidiary does not automatically become a permanent establishment unless it itself acts into a capacity of a dependent agent for the non-resident.
So for the last question, Rutvik,
Yeah.
If we say that when we look at a business connection, we are looking at a connection with the foreigner's business in India.
Yes.
Really. So basically the relationship of that connection is irrelevant. Whether that agent or whether that the party who's the connection of the non-resident's business, whether it is related or not, is not a factor which will determine business connection.
Very
so as long as the connection is with the business and there are operations in India, attribution will follow.
Yes, actually.
For P, of course, we are not answering. For permanent establishment is a different kettle of fish. So we leave it for other faculty to answer.
I'm not very clear about the next query, which is saying that the scenario where the Indian engineer does the clearing installation services to the foreign machinery supplier. The machinery was supplied to an Indian purchaser.
So,
Okay.
so
Okay.
see, the question is there a supply of machine by the non-resident to the India? So whether it's a business with India or business in India, that probably is a question.
Correct. Yeah.
So go ahead,
Yeah.
Rutvik.
Yeah. Okay.
Rutvik,
Yes. Yeah.
probably that's what, whether that Indian engineer becomes an agent of a foreign company. That's what maybe it's the question.
Okay. Ha ha ha.
That's what I feel. I don't know what is that.
Yeah.
I understood that he's asking the question whether that Indian engineer will become an agent and whether that foreign company
Okay. Understood.
means have a business connection in India.
Understood. So see, in this kind of a scenario, I think what you should bring out is that generally speaking, any supplier, any foreign supplier who supplies machinery or goods to India would definitely employ the services of a clearing agent. They are not going to have come to India to do the clearing or the installation. They will have somebody else who will do that job. As far as that person who is doing that job is an independent agent or is an independent character, in the sense that you have so many clearing agents, right? The clearing agent will be doing the similar services for many people, for many of its customers, including this particular foreign supplier, in which case there would be probably no business connection in India. But if you have a case where the person is actually doing it only for one particular foreign supplier, and it is actually kind of in control, that Indian engineer is, at the back end call of the foreign supplier, there is a very good chance that yes, it could lead to a business connection, and there could be a chance that yes, he is actually becoming the business connection for the foreign supplier. I hope I am somewhere, but this is, frankly, you would have to go into the very bare, kind of lot of detail of the facts before, let me not give a generalized answer. But from whatever limited facts are here, it seems that be the case. I'm sorry, I will not be able to. I think one of the questions is on GST implications. We will not be able to cover it here. Yeah. I hope we have answered the queries. Yeah.
Shall we go?
Yeah. SAP Ganesh, you would like to start off? How would you like?
No, you carry on. You continue.
Okay.
I'll jump in whenever.
Yes.
Rutvik and Ganesh.
Yes.
Yeah. Another, you can speak for another 30 minutes.
Right.
5:50, we will take a break for 10 minutes, and again you can 6 o'clock again you can start.
Sorry, at what time? 5:50, right?
Yeah, 5:50. Another 30 minutes you can speak, and we will
take
a break.
Yeah, got it.
And then you can start off.
No problem. Yeah.
Okay.
Okay. Thank you. So coming to the significant economic presence, it was introduced by the Finance Act 2018 by way of explanation 2A to section 911, a new explanation which was brought in. But the whole provision was actually replaced and it was reintroduced by Finance Act 2020. But then the effective date was 1st April 2021. When it came in Finance Act 2018, it was not brought into effect. It was clearly clarified that it was not going to come directly into effect at that particular point of time. It was delayed. The application was supposed to be delayed. However, Finance Act 2020, when it brought in, it said that yes, it will apply from assessment year 22-23, and therefore it means that from financial year 21-22, the SAP provisions apply. So as we today speak, the provisions are applicable, and therefore, you can go into that. It has become a serious issue today when we talk about that how it applies to all the business transactions happening within India. Just a bit background, it was a concept which was raised in BAP Section Plan 1. It was essentially on the report on digital economy, where you have a lot of trade which is happening by way of e-commerce, by way of digital transactions, which are not getting taxed in India. And how do you capture or not getting taxed in several countries around the world? And how do you bring that to tax? One of the options offered was significant economic presence, after which also equalization levy was also one of the options which was suggested. And those both options have actually been exercised by the Indian Income Tax Department. It is also obviously in place within USA, though USA does not agree to bring in such a provision across the world. But within USA, within trades between the states, there is the concept of significant economic presence. And it has also been strongly promoted by the European Union as an option to tax e-commerce. We will not go into much detail about what the future holds because it is actually changing as probably on a week-to-week basis. It removes the requirement for a fixed place of business to constitute a permanent establishment. The whole idea is that permanent establishment, what it defines as a fixed place of business in a particular country, it is archaic. It has gone past its use. It has gone to the, it's referring to the days when you could have done business only through having a shop or an establishment in a particular country. Long gone are those days. Today, you have used business happening with foreign countries without any presence of those foreign countries in India, just simply because they have probably a web presence or a digital presence or simply an app. And therefore, the permanent establishment definition has quite outlived its use. What it does is that significant economic presence says that it relies on certain other factors, where it says that if those factors or those thresholds are met, definitely there is a good enough presence of the non-resident within India. Because obviously, if you would not have such a huge business without having certain presence in India, though that presence may be outside, although the operations may be fully outside India, but there will be deemed to be a presence within India because just because of the sheer amount of volume or the sheer amount of transactions which are happening within India. Yeah. Please bear in mind again that SAP is finally brought into the Income Tax Act. The double tax avoidance agreements are nowhere redrafted. It will still remain with this old archaic rule of permanent establishment being a fixed place of business. And until that is not met, there would be no further taxability within India. And therefore, we have equalization levy kind of a concept. SAP has only been brought in just so that tomorrow when there is a renegotiation of treaties, then you would actually kind of bring in the tax, and there is an SCP brought in by way of the treaties. Then in India also there is a provision to tax by way of an SCP. But what has happened is that significant economic presence has gone way beyond the issue of digital economy. The reason being that transactions which are in respect of any goods, services, or property are covered, and it covers all business transactions, not necessarily through digital means or not those only for digital goods. And therefore, one famous example is that what if Aramco, the Saudi Arabian company, it sells oil beyond a particular threshold limit? Does it mean that an SAP is constituted in India? I don't think that has been the intention. Unfortunately, the language is drafted very, very broadly. At the same time, by not focusing only on the digital aspect, it obviously avoids ring fencing, which is one of the major complaints of the digitalized economy. What is exactly digitalized economy? What is exactly digital business? It is very hard to say. A traditional business, like for example, even the Aramco selling oil may have its own website and order sheet which is online on a certain platform. You have so many regular run-of-the-mill products which are earlier sold through normal means or by having a shop or establishment in a particular country, which now happens cross-border through a platform. Right. So you may not necessarily say that, yes, there is a difference between a normal economy and a digitalized economy. Every economy or every kind of business model largely tries to become or adopt a digitalized model, right? We are seeing, right, with the Ubers and the Olas, even our normal cab ride has become a digital mode. In a sense, at least the booking of the order has gone through digitalized model, the Swiggies and all. These are obviously domestic transactions. So the point we are trying to make here is that almost every business has become digitalized in a manner, and therefore probably significant economic presence has eschewed of these words of digital and all those narrow scope of the provisions. They have gone much beyond digital means or digital products. Even after April 2021, when the provisions actually became effective, the threshold limits are still not prescribed. It was like, it was in limbo. The provisions could not be applied unless there was a thresholds, but they have now been prescribed. But unfortunately, they are quite low. Let me go through those. Essentially, we'll go through the thresholds, but essentially they are, 20 crores worth of sales which happens, or 3 lakh users. These are considered to be abysmally low figures as per what industry says, because then it probably caters to almost everyone. But but at the end of the day, it still remains that these are the thresholds today in place. Whether they change or not in the future, we do not know. So what does explanation 2A main clause say? It says, for the removal of doubts, it is hereby declared. What we have put and what we have corrected by way of cutting a particular clause or a word is what was earlier there in Finance Act 2018, but Finance Act 2020 actually changed those wordings. It is earlier what was clarified as if that it was always there. but then they have changed the wording to hereby declared, which means that obviously it is a prospective provision. It does not mean that it's a retrospective, or even though it means an explanation to something which has been there since decades now, does not mean that it is something which is brought in from that particular date. It is a prospective provision. For the removal of doubts, it is hereby declared that the significant economic presence of a non-resident in India shall constitute business connection in India. So what does it say? It does not automatically say that significant economic presence brings taxability in India. No, it says significant economic presence constitutes a business connection in India. Okay, so that is how they have probably brought it out, and therefore then you go back to business connection principles and try to see how the attribution of incomes probably happen, or if there are any attribution principles specific to the SEP. As I already mentioned, its prospective applies from AY 22-23. And SEP of NR in India to constitute business connection, SEP of NR in India or SEP in India of the NR. I think there is some kind of loose wording here. It could have been a much more appropriate if they would have said that it was an SEP in India of the non-resident. Unfortunately, wording, and as I mentioned earlier, recent amendments in law are not the most or not the best as far as drafting goes. And SEP is in addition to the classical business connection. You can have a case where your normal business connection itself applies. Then you do not go to SEP. But it is in addition to the existing business connections or the principles of business which are already laid down in the law. But SEP meaning is exhaustive. It says clause in exhaustive in the sense that beyond that nothing else gets covered. Unfortunately, the provisions itself are quite broad. That there is not much left to be uncovered now. Clause A and B, they operate independently, and the thresholds are also to be applied separately. The separate thresholds are given for both clauses A and B. And there's no requirement in law that a transaction with a person in India has to be through technology or automated tools or through digital means. As I already explained, they have removed those kind of narrowness of the provisions. They are as broad as any trade happening through, even for example, a phone call, something which is not using any digital means at all. You probably say write a letter and place an order with Aramco of $1 billion worth of oil sale. Yes, it gets covered under SEP just because it has crossed the threshold. As we already discussed, SEP provisions do not have an impact if the NR is entitled to a treaty. This is not provisions which are anti-tax avoidance provisions. Please bear in mind, these are not anti-tax avoidance provisions like the GAR, which, for example, may override a particular treaty. But that is not the case here as far as SEP provisions are concerned. So coming to limb A, significant economic presence for a purpose shall mean A, transaction in respect of any goods, services or property carried out by a non-resident. Earlier the wording was in India. They have replaced it with any person in India. Earlier the provisions were obviously loosely drafted, not very well drafted as far as Finance Act 2018 was concerned. They corrected those wordings. Now it says that transaction in respect of any goods, services or property carried out by a non-resident with any person in India, including provisions of download of data or software in India, if the aggregate of payments arising from those kind of transactions exceed the amount prescribed, which is rupees 2 crores annually prescribed. And again, they have brought in an kind of provision which says that it need not be that those transactions or activities are entered in India, the agreement is entered in India for them, or the resident has a place of business in India, or the non-resident renders services in India. It is not required that there is any presence or any activity which happens in India. That is the whole idea of significant economic presence. They want to deem a particular business connection just on the measurement of certain thresholds of volume and the revenue limits. Transactions are to be carried out by the non-resident with any person in India. This is a nuance which Ganesh has spotted, that it is talking about any person in India, not any person resident in India. Ganesh, would you like to elaborate on this?
So basically, we are just trying to understand, this slide actually tries to understand what is this with any person in India mean. Does it mean with any person who's a resident in India? Obviously, no, because they don't say that. The provisions do not say that. And if it is not with the person who's a resident in India, then what are we talking about? Are we talking about the person with whom the non-resident has a transaction in respect of any right, in respect of any goods, services, or property, who at that point in time was in India physically. Right. So basically, that's a sort of confusion with the loose manner in which the provision has been drafted. So now let us see. Let us examine. Now we have the provision, and it is already in law. It is already. We need to anyway understand what it means as it is provided in the law, as it is enacted. So what could be those propositions? Let us see. So this table below gives that. Let us say the person with whom the non-resident transacts could be a resident or could be a non-resident under the Income Tax Act. Now, if that person is a resident and the transaction is with the person when he was in India at the time of the transaction, obviously it is covered. There is no confusion there. I would believe it will be covered even if the transaction is with the non-resident when he is in India at the time of at the time of the transaction. So your row number one, I've given 3 tick marks. So these tick marks indicate my level of confidence in my answer or the lack of it. So it could be either way. So basically you will find some ticks, some crosses, some ticks and cross mixed. So this is just sorts of, it's like a thermometer. It gives you my thinking at this point in time. Of course, you can do your own analysis of what you think should be the provision. And there are no precedents available. So we are really looking at, we are writing on a blank slate. So it's up to us to understand, make sense of what the law says. When the person is not in India at the time of the transaction, I'm talking about the other party, the counterparty to the non-resident, whose SCP we are determining. If he is not in India, obviously I think it should not be covered.
Even though the person is a resident.
Even though the person is a resident, yes. Let's say I go abroad and take a haircut. It's a famous example which is often quoted. So why should the salon pay tax under ACP? There's no correction. Really speaking, the nexus with India is not there. Forget about just because I'm a resident wherever I go, the nexus doesn't follow me. So basically, my understanding is the row 2 should not be covered. Then we have at any time in India, even if he is not in India at the time of the transaction. Like I could have done a transaction abroad and I would have come to India as a non-resident. Now, or I could be a resident who was been in India all along, but for a month I go abroad and take a haircut and come. Whether the salon will be now subject to tax? No, question is no. Is what I believe, but I kept that as one cross. Okay, so it is not as what I will say, as emphatic an answer as the second row. Or of course,
so there is an exhibition in India, Ganesh, and
yes.
A foreigner comes to India, sees the goods, he looks at them in the exhibition and he says that, okay, fine, he finds them likable, but then he goes back out of India and then places the order.
So now there you have what is called your exemption available for diamonds in 1E. It's exactly this what you are saying. Yes. It is about exhibiting diamonds in specified locations in India. It is meant to attract the purchasers who will the purchase. There they have given a specific exemption. No, but that is under your classical business correction. It is not SCP. So a classical business correction accrues if the exhibition happens regularly. Right, the place of the person who's exhibiting those items could be the business connection for the non-resident seller. But now here we are not on that. Here we are on presence of the person in India, the counterparty to the non-resident, his presence in India. So I would believe that it's very doubtful that a person is in India at any time in India, but at the time of transaction is not in India. I would still believe it is not be covered. But as I said, it is not as emphatic as row 2. Now, it could be having a branch in India. Though transaction is not related to the branch. The branches are presence of the non-resident. He is continuously in India, but the transaction is not related to the branch.
Correct.
So in that case, I am ambivalent. This is a transaction with the person in India, though it is not related to the branch. So I put a cross and a tick both. So you can take your pick. And then we have having a dependent agent in India, though transaction not related to the branch. So a dependent agent is a separate person. So obviously it should not be covered. A dependent agent will cause a PE, possibly even a business correction. But either way, a dependent agent is not the person with whom the transaction is happening. Is the dependent agent is actually a relationship which constitutes a nexus or a connecting factor with India for buyer. So I would believe no. And a business connection also is would not be a business, would not be a person. The person is somebody else who's sitting up, whose business connection is found here. So this is a sort of a template to you can play around with this as you go along. Maybe like 6 months down the line, you can again revisit this schedule.
Somewhere you find similar provisions even under equalization levy, where they say that even if a non-resident is in India, or if a person who has an IP address within India and the transaction has happened, they are trying to bring it to tax. Probably that is where somewhere they have not said with any person resident in India, but with any person in India with a purpose. And as you said correctly, there would be exceptions then. If the resident goes out of India and does the work, or the non-resident transacts with such a resident who is at that particular time out of India, then yes, you're right, there may not be SEP which will come into force. In a way, it's probably logical also. Why should it be? But yes, it will only be time which will then forward tell. Yeah.
Yes. So this is just a sort of a mind game I played with myself. So I thought I'll share it with all of you.
Yeah.
Carry on.
So going forward, Explanation 2A Limb B. Significant economic presence for purpose shall mean systematic and continuous soliciting of business activities or engaging in interaction with such number of users in India as may be prescribed. So please make a note. Users in India was not, which was earlier mentioned. Now they have brought in that with such number of users in India as may be prescribed. Again, through digital means was what was earlier mentioned. That has now been removed. And therefore, you would bring into tax anybody who has any users in India, as far as there is a significant economic presence as with respect to limb B. Again, here the prescription is 3 lakh users, which people feel is very low. But bear in mind that if you look at the fact that yes, only considering limb B, obviously customers or big customers like big non-residents like Aramco, etc. would go out because they would not have 3 lakh buyers in India, 3 lakh users in India. But at the end of the day, again, those obviously the expansions or the exclusions which they brought in, that a person, even irrespective whether it is a place of business or whether it renders services, still remains even for limb B. But a lot of these wordings have not been actually provided. There has not been any kind of, you can say that any clarification provided to all these wordings which are used. What do you mean by systematic and continuous soliciting? Probably they have left it to the generic meaning which we understand of those words. And there are certain issues with it. Can this, altogether new provision be brought in by just expanding by way of an explanation? Time will come to see whether, there are issues to related to it, whether they bring that out. Can that expansion be made in definition for the removal of doubts? Ganesh will be taking up the Engineering Analysis Center of Excellence Private Limited decision of the Supreme Court recently, which also commented on these kind of, amendments brought in law, which obviously are not, with the removal of doubts. It cannot be that SCP was visualized in 1962, definitely not. And it is a new provision. So how that will impact even these kind of provisions we'll come to know. It's definitely prospective applicability that the department is also quite clear about.
Actually, Rutvik, before
yes.
one point, I don't know whether we are dealing with this.
Yes.
If we look at SCP, where does that leave the classical business connection which we discussed for last 1 hour?
You mean to say that whether it would have any major importance now with SCP being there?
Yeah. So means is it really required, or is it quite possible that you have both business connection and your SCP business connection, classical business connection and SCP business connection, both overlapping, and which one would you apply? At the end of the day, the attribution rules for both are different, right? So basically, you have explanation one day which talks about reasonably attributable to the operations carried on in India, while attribution rules for SCP is attributable to the transactions relating to constituting the SCP. So with the attribution rules also being different, as a taxpayer, can I choose one of them? Or as a tax authority, can they choose one of them, whichever is more revenue friendly?
True.
So the point is, this provision has to be read down. If you do not read this provision down, it will not be workable.
Very true. Yeah, yeah.
The challenges coming in, challenges brought to the courts to decide upon this provision. The view,
Very
I think, of the view of the revenue appears to be that anyway you have a treaty protection, so this provision will never get applied. And if and the domestic law should always be wider than the treaty. From where they get that understanding, I don't know. Why should domestic law be wider than the treaty? Domestic law should tax something which has got the nexus as per the constitution, as per Article 245. Only when there's a direct nexus with India, that ability to impose a tax arises, or making a law relating to taxation arises. If the nexus is a counterparty, a nexus, a counterparty to a cross-border transaction, would he amount to a nexus? That's the question. Just, I think, what is called? It is too stretched. Look at section 9, section 916, 917, 915 for that matter, interest, royalties, and FTS, where the payer is a resident, and you have an added condition that the right property information is utilized in his business in India, or for the making or earning of source of income in India. So there is a dual condition. Here there's nothing. If I am the payer or if I am the counterparty, SCB triggers. So obviously, I think this provision will be looked into by the courts, definitely.
I agree. And that is where, this explanatory memorandums will also come into play, because they have clearly said that, digitalized business or digitized businesses which are not leading to business connections in India is what they were trying to capture through a SCP. Unfortunately, those all terms have been removed, and then SCP has been made much broader than what it was actually destined to be. I think you're right. Either the courts or probably the department itself will realize what they've done, and just like in the residential status for NRIs, they first brought in a big change and then they had to water down everything. So let us see how it goes. But business with India and business in India, is the position changed? I think that is what probably Ganesh also holds this view, right, Ganesh? That it is for accrual of income while SCP is for deemed accrual. And so if the title of the goods are passed abroad and income also has not accrued in India, then deemed accrual rules need to be examined, including SCP. Now, to that extent, yes, it may change, but otherwise, the accrual of income as per section business connection remains in place. The section 5 accrual principles also remain in place.
Yes.
Does SCP also drag in other income like capital gains, interest, or it attracts only business income? To my understanding, this has been deemed to be a business connection. Once there is a business connection in India, do we say that other incomes also get taxed for that particular business connection? To an extent, probably once you have a business connection, all incomes attributable to those operations, or in case of an SCP, to the transactions which lead to an SCP, remain taxable. But that is where probably you will have a cutoff, because the transactions are probably in relation to their businesses, where you have a turnover of 2 crores or where you have a 3 lakh more than users. Now, those are the transactions which they are targeting. So probably it may get limited to business incomes only. Unlike a business connection under 911, the erstwhile business connection, or what we can say whatever was there since a long time, in which it was saying that income attributable to the operations carried out in India, which could have encompassed certain other incomes also, but may not be the case here. Obviously, attribution rules are very frankly not, it's in a two-liner manner which they've given for SCP. Much more needs to be debated about. There were rules which were actually framed, draft rules were announced, and unfortunately nothing has happened to that. So we don't know how exactly they are planning to apply attribution in these cases. Coming back to equalization levy, I'll now speed through. I understand. Okay, we're at 5:50. I think we needed to take a break.
Would you like to finish equalization levy and then the break can be taken?
I agree. Logical. If members do not mind, we'll just, I'll finish it off in 5 minutes so that we can take a break after that, so that, later on it can start from the post after that. Equalization levy.
That's okay.
I think
That's okay. You can go ahead.
Thank you.
Yeah. Thank you. Equalization levy, again born out of options which are recommended in BAP Section Plan 1 report. The 2016 amendment were brought in to bring into tax only specified services which are nothing but advertising services for the moment, online advertising services on which a rate of 6% is applied. 2020, it was as if there was a new, a new mindset which was there in play. Of provisions of 2016 were kept on the side, and 2020 provisions expanded the scope by an extreme level. But they obviously put the rate at 2%, a lower rate. But both provisions are quite different. We have issues on equalization levy also, whether that levy is a tax or not. If it is a tax, whether it is a direct tax or an indirect tax, whether the double tax avoidance agreements will override the equalization levy. There has been, surprisingly, this provision has been there from 2016, but we have not seen any litigation on these aspects. So maybe they may come now in the near future, but till date, nobody has debated on how double tax avoidance agreements will probably override equalization levy. People have held their own views, but nothing has been litigated. It seems largely it seems that people who are affected by the 2016 amendments are quietly paying off the equalization levy by either passing it on to their consumers or bearing it on their own. Whether the same will hold true for the 2% levy, which is a much wider scope, we will only come to know now in the near future. 2016 features were that they were a levy on the payment received by the non-resident payee, but they were paid by the payer. The levy was paid by the payer. It was not on the non-resident earner of the income. It was by the payer. In that sense, the burden was always on the non-resident, on the resident. And this is the applicability. I will leave this for the moment because we can speed through this. This is there in the presentation slides, which will be shared with you. You can always have a look at them later. There are issues with regard to specified services, the online advertising services, whether it covers review websites, whether it covers provision for digital advertising space. Does it cover when you go to an app store and there are certain apps which are shown on top and certain below, all on a website where on an Amazon website where you have certain products shown above and certain below. These are all questions which are still unanswered. They have not given any guidance, and people will have to go by putting their own interpretations to the issue. 2020, I again mentioned a huge difference in or huge wide ramifications, very enlarged scope. People have been worried about how to apply this. The 2% levy is the only saving grace. That just because it's a 2%, it may save, but there are people who are trading. There are people who are traders. There are platforms which earn actually nothing but a commission income, for which the 2% actually becomes quite a bit. So again, applicability is on a non-resident e-commerce operator. Here, at least the provisions have applied to the non-residents and not to the resident. The burden has been shifted clearly to the non-resident. But bear in mind the exclusions, and whereby the sales or turnover, if they cross only 2 crores in the previous years, only then they will be covered. Also, royalty or FTS in India, if it is liable to tax as per royalty or FTS, then these provisions will not apply. There are quite a bit of concern towards it. They have amended the law to correct that. But still, there are issues at Interplay, which Ganesh will take up, few slides down. E-commerce operator, what does it mean, and whether facility, if they are not defined, what they will include. Unfortunately, there is not any guidance on this. Again, wordings which have been used. Do we go by generic meaning? Do we go by any intentional meaning as far as digital kind of concerns is concerned? Nobody is clear on that part. Supply of services, e-commerce supply of services is the main ground on which they are levying the levy. They're applying the levy rather, and that has been broadened by the Finance Act 2021 by saying that online sale of goods would mean any of those online activities, by acceptance of offer for sale, placing of purchase order, acceptance of the purchase order, payment of consideration, or the supply of goods or provisions, partly or wholly. This one amendment has widened the scope of year 2020 provisions by probably, I don't know, innumerable times. So this is where the provision lies. Persons covered, again, EL provisions would apply. Yeah, again, this issue on which are the persons covered is still an open issue. There are certain issues I'm not going in detail because there are many more other issues which we are covering today. Yeah, the broadening of the scope is also by part of persons who are covered under specified circumstances, where they have stated that a person who is targeted, specified circumstances means sale of advertisement which targets a customer who is resident in India or a customer who accesses the advertisement through internet protocol address located in India. or alternately sale of data collected from a person who is resident in India or from a person who uses IP address located in India. This is what I was trying to say, is drawing some parallel to an SCP to a person in India and not necessarily a person resident in India. EL provisions also seem to have similar wordings. At the end of the day, there is no, again, guidance given for what means by target, what means by access, data. All those are probably left open for interpretation. Again, sale of data, there is a chargeability to the sale of data itself, how they will charge it, what do they mean by data, how it should be collected. These are all provisions which are open. You can refer to our slides and we will have more questions, and unfortunately there are no answers. So that is why we are speeding through this, because there's no point of just laboring you with questions with no answers, but answers will probably come sooner or later. There are certain other legal issues which apply to intra-group services, whether it will be chargeable as only on a part or a composite of payment. So these are the concerns which several representations were made. Unfortunately, hardly a few of them, or rather those where they felt that there was an issue in taxing, that is what got amended, but rest all have been left aside. And finally, we have the interplay. The basic simple premise is that you will have first the equalization levy 2016 provisions which will apply, then the EL 2020, and then you come to the Income Tax Act. The only reason being section 10, section 10's clause 50, which provides an exemption from income tax to anything on which EL apply. Therefore, this hierarchy. Now, however, they realize that EL 2020 actually brought in scope even royalty or FTS, so they have now excluded that part. And then finally, we have the SEP. So all put together, it is a mishmash of things where the interplay can go from here or there, which is why then we have learned speakers like Ganesh to deal with those interplay provisions. And I think that we will deal with after the break. Yeah, Ganesh, I think we can take the break now and we can.
Any questions on these? Then we'll take the break, no?
Yeah, sure. Okay, the first question, can we take a break? Yeah, I think. Yeah.
Got anything?
I think in light of recent court decision, kindly throw light on taxability of license fee of software. Yes, Ganesh will be taking it up. I think we can jump to royalties, after this session, after the break probably.
Yeah.
Indian company paying the fees for FTS or to Singapore. What is the rate if Singapore company has a P in India or a Singapore company does not have a P in India? Once there is a P in, anyway, sorry, this is off topic. I will probably keep it for tomorrow's session or the session on P. That might be much more helpful.
How come I don't see these questions? What you're
It's
reading
in the
from?
chat window.
Sorry?
It's in the chat window. Chat window.
Chat. Okay. Sorry.
Yeah, we have a separate session for PE and all. We can
Yes,
so
exactly.
that can be discussed then.
In the context of SAP is 2 crore limit applicable to transactions with a particular person in India withholding
section
tax.
9. Section 9 only.
Yes. Yeah.
Tomorrow we'll have a PE and a business.
Yes. Understood. Yeah. In the context of SAP is 2 crore limit applicable to transactions with a particular person in India. No, sorry, it is not so. It is with overall limit. Yeah, sorry.
Good. Sorry.
It is an overall limit to a person in India, but not to a one particular person. There is a 2 crore limit annually applicable, but there could be more than one person in India to whom this limit applies. So SCP is overall. It is not just one person in India, but definitely persons in India, as Ganesh correctly pointed out. If there is a business, especially in these kind of online businesses, it could have persons in India and outside India both accessing the same portal or the same website. It will definitely, they will have to bifurcate between those who are in India and not outside India. And I don't know how they will do that, but anyway, so that is the issue, one of the issues that we are dealing with. Thank you, friends. I think we'll take a break here and we'll, I think, reassemble in 10 minutes at 6:10 so that we can start again. Yeah.
Oh.
Thank you.
By 6:10 you can start.
Yeah. Thank you.
Thank you.
Chairman, ನಾನು join ಆಗ್ತೀನಿ.
Okay, fine.
Okay.
Welcome back, friends. Welcome back, friends. Now we have our regional council member Pampanna B also joined with us. Hearty welcome, Pampanna. Friends, I'll take a minute of you to inform the upcoming program of our branch. 21st June, Monday, coming Monday is International Yoga Day. Your branch is conducting Yoga Day in the early morning, 7:30 to 9 p.m. An expert in yoga and other issues. So Dr. Naveen K. Vishweshwaraya is joining along with his team. First 45 minutes is going to talk and explain all the benefits and advantages of yoga for health and others. And next 45 minutes, it's going to be a practical session on yoga. So I request you and your family members to join that program. Register to that program. You please visit bangaloreica.org. Coming Monday, 21st June, International Yoga Day. Please join with us. With that note, once again, hearty welcome to all of you. Over to speaker. Please go ahead, sir.
Welcome back, everyone. We will try to now take through the presentation in a manner which gives us justice to the other provisions as well, because it may probably be that we are going much more in depth on certain provisions, but others may get behind. So we will now start off with the other limbs of business connection, of section 911. Before we go into that, I'll just start off. Sorry, are you able to view the screen?
Yeah.
Yeah. Section 911, other limbs, is that the slide on, or is that?
Yes, that is it.
Okay, so the other limbs to section 911 are obviously the property in India, as I already mentioned to you earlier, that these are kind of, probably you can put it this way, slightly more straightforward than the ones dealing with business connection or transfer of capital assets situated in India. Income accruing or arising through or from any property in India is deemed to accrue or arise in India. It covers any property in the ordinary sense of the word, but the property must definitely be tangible property. Okay, so this is what I will not go into further detail into this. Asset or source of income in India. Again, the term asset would also include, so income from any asset or source of income in India will also be constitute a, will be deemed to accrue or arise in India. Again, the term asset has not been defined, but it would include all intangible rights as opposed to property. Well, the expression source of income refers to other sources of income falling under section 56. This is one view, obviously, which is given by the income tax inquiry report. And there are certain decisions based on that, which are all covered by us earlier when we dealt with section 9 a couple of months back for Bengaluru plan. I understand those presentations and videos are available on their website. So I'll not spend more time here on these, which was already covered. Transfer of a capital asset situated in India. It is obviously designed to catch any capital gains that a non-resident may make by the transfer of his asset which is situated in India. The provision obviously refer to location. Location being that the capital asset has to be situated in India. This was what was taken as a benefit by a person to indirectly sell off the property, indirectly sell off the capital asset which was situated in India by transferring the shares of a particular company outside India, and therefore, kind of leading to an indirect transfer of assets. This is where the famous decision of Vodafone BV, in the Supreme Court decision came out, where, you had Hutchison Telecom, which was solely selling off its whole business, mobile telephony business in India, to a layer of companies, which eventually led to that Vodafone essentially bought out those telephony business, and by just selling off one share of a Cayman Island company. And obviously that triggered into a huge controversy. We all probably would have heard of the controversy and how the decisions went twice up to Supreme Court, then twice up to Supreme Court and back, and then finally the decision of the Supreme Court was in favor of the taxpayer by looking at the look at principle and not the look through principle. Anyways, the point we are trying to make here, and this has all been explained to by us in our slides, the point that we are trying to make here is that this led to a change in the terminology, change in the wording. There was a feeling that a counter was supposed to be made to the decision of the Supreme Court, and therefore an explanation 5 was brought into section 911. It was inserted by Finance Act 2012, but with retrospective effect. And it said that it widens the scope of 911 and taxes gains derived from transfer of capital assets, deriving its value substantially from assets located in India. Later on, a provision was brought in that it would not apply to assets or transfers made by FIIs or Category 1 or Category 2 FPIs. But that apart, the how to build or how to get to tax indirect transfers in India, it's not an easy process. This is where somewhere I would put it this way, that while we have been critical about the recent amendments which have been made and how the language has probably been badly drafted, at the same time, if you try to bring into tax something sort of indirect transfers to tax in India, how to go about it is also something which is I would put it this way, it's not so easy when you put it down into law. And therefore, you have explanation 5, explanation 6, explanation 7, each dealing with certain segments of the whole overall provisions relating to what is now famously called as the indirect transfer provisions. Therefore, explanation 5 obviously brought to tax something which was essentially happening outside India, but whose value was derived substantially from India. Finally, explanation 6 brought in a threshold whereby it said that it would be applicable only to transactions where it would cross more than 10 crores or the value of the assets located in India is more than 50% of the value of the total assets of a company. And finally, explanation 7 brought in that it was providing exemption for where the non-resident does not hold the rights of control or management. So you would have a case where a person is actually valuation is more, but he does not exactly control. It is more of a portfolio holding, and there again there are certain exemptions which are brought in. There was a circulars also which were issued, circular 4 of 2015, whereby they say that actually it was supposed to be targeted for capital gains, and therefore the declaration of dividend, because see, what was happened was that by way of explanation 5, they actually deemed the particular asset to be located in India. Please bear in mind, this was not like SCP which deemed something to be a business connection. This was not something which was deeming the accrual to take place in India. No, they deemed those shares to be situated in India. This is quite different from what other provisions of what was otherwise in place earlier under section 911, which essentially deemed the place of accrual to be in India. Somehow they did not do so. They did not say that no, the place of accrual is deemed to be in India. They straight away said that a factual in reality there is a shares which are located outside India, they will now be considered to be located in India. Obviously, that definitely brought in the capital gains to be accruing in India, but then the other incomes also commensurate to it would also get taxed in India. Therefore, they brought in a circular to clarify that dividend incomes will not be covered. It was only the idea was to cover capital gains. Just to give simple kind of illustrations, Cayman company which holds 100% investment in a Mauritius company. Mauritius company is the holding company of the Indian company 100% and the Sri Lankan company 100%. Now the value of the India company standalone is 8 crores and Sri Lankan company is 5 crores. So we are below the threshold of 10 crores if you value only the Indian company. But do then also take into consideration the Sri Lankan company's value, because what if the Cayman company sells off the shares of the Mauritius company? Its value is derived substantially from India, or is it that the threshold valuation crosses 10 crores? It does not if you consider only India. And therefore your explanation 6, where it says that it will be declared that a share or interest referred to in explanation 5 shall deem to derive its value substantially from the assets located in India. Okay, so that is something which you have to bear in mind. These are simple illustrations to just bring in light that what are the explanations, what they try to bring in. You have another kind of a case where, say in this case, the Sri Lankan company is actually owned by the Indian company. Now what do? Do you say that no, there is still a valuation derived of Indian company's value is 12 crores and the Sri Lankan company is 15 crores. So do you say that no, we consider the full valuation or not? In that case, you have the rule 11 UB clause 8, which says that determining the fair value, market value of any asset located in India being a share of an Indian company. In that kind of a case, all the assets and business operations of the said company shall be taken into account irrespective of whether the assets are located in India or outside India. Please bear in mind, if the Sri Lankan company is owned by the Indian company, in this kind of a scenario, you will have that you will have to take into total valuation and not just the limited valuation of the Indian company, because Indian company also owns the Sri Lankan company's value. Irrespective of where the assets are located, the valuation will be counted. These are simple illustrations. I think I will not, go into further detail on these provisions. These are all explained, and why, we are trying to bring out that what exactly these explanations try to bring out, what exceptions they try to bring out. I will probably, just come straight to the fact that at the end of the day, again, with section explanation 5 to section 911, again with the indirect transfer provisions, these are all finally provisions under the Income Tax Act. And at the end of the day, it is provisions which are subverted by the application of treaties. So you have the Sanghvi pasture ruling, whereby they say that in case where the transaction is happening outside India, you are trying to apply the indirect transfer provisions. However, you have the treaty in place. You have the tax treaty between India and France in place, which actually overruled the provisions of the indirect transfer provisions. And obviously, those double tax avoidance agreement provisions will hold good. There can be another view to say that indirect transfer provisions are in essence I would put it this way, an anti-tax avoidance provision, right? So that is what they are all targeted towards. Whether those would override the treaty, it's a divided view. Obviously, the ruling of the High Court holds that no, it will not be. The treaty will override the provisions of the Income Tax Act. This is, briefly what indirect transfer provisions are relating to. This is where we close on 911. If there are any questions, please put them on the chat box. In the interest of time, I am proceeding with section 912, dealing with salary. Again, salary, taxability of salary income in India is clearly covered by 1 minute. Yeah. Hello, can you hear me?
Yeah, I can hear you.
Yeah, sorry, Ganesh, do you want to add on 9.1 on indirect transfer, or should I proceed?
No, I think we should proceed unless there are questions which we can take up. Then we can take up if there are questions.
Yeah. At present,
I don't see any now.
Yeah.
But there's somebody had put up their hand, so I don't know whether.
Oh, okay. I didn't notice that. I think we can proceed. Let them put up the
Yeah, we
question.
proceed. Then the questions come, we'll take it.
So, taxability of salary income in India is governed by section 6, read with section 15. And again, as we already discussed, connecting factors being the residence and source, which we know Ganesh explained at the very start. I will just briefly take
those
you
who
to,
raised hand, we can ask them to talk. Is that okay for you?
My
Okay,
suggestion,
you
sir,
can to
would
speak
be,
if you want, sir. Otherwise,
no,
you can.
my suggestion is if they have put in the question, if we do not
Yes.
understand the question, then they can come in.
Okay.
That will save time.
Participants, please put your questions in chat box or Q&A. Thank you. Bye.
Thank you. We dealt with this again. Section 5 of the Income Tax Act is what you will first see. Then Section 9, going to Section 15, which leaves out the timing of the taxability of income, and then you go to the double tax avoidance agreements. Again, section 9, income deemed to accrue or arise in India. 9.2, what does it say? That the following income shall be deemed to accrue or arise in India. Income which falls under the head salaries if it is earned in India. And then the explanation says, for the removal of doubts, it is hereby declared that the income of the nature referred to in this clause payable for service rendered in India, and obviously the rest of the leave period, they shall be regarded as income earned in India. What it does is it shifts the place of accrual of salary for employment based outside India to India, where the salary has been earned in India, where it is actually that the services are rendered in India. And then section 15, what it does, it gives the timing of that accrual of the income. Where does it where does it income accrue? It income accrues in the earliest of the years where the salary is due, paid, or arrears of the salary if they are, then in wherever they in whichever year they are actually received. So this is how they are actually trying to bring out the timing of the taxability, which also becomes important to determine exactly when the income of the non-resident gets taxed. I have brought out in that issue kind of a case study. I am not going to accrual versus receipt right now. What I will first try to bring out is that exactly accrual of salary as far as section 5 is concerned. Please bear in mind that section 9 talks only about earned in India. It is section 912 is an expansion of scope as far as section 5 is concerned. Section 5 itself first you have to determine where does salary get accrued, where is it within the scope of income. It will be where it determines the scope of salary income, where it will be taxed. It will be where exactly the employment base is concerned. Employment base is a term which I have kind of termed. However, what I would try to mean is that it will be where the place where the contract is made, where the payment becomes due, where the salary payment itself becomes due for the employee. This is slightly different or kind of in contrast to the place where actually the services are rendered. So please bear in mind that section 5 talks about accrual of income. And in my view, the accrual of income takes place exactly where the salary becomes due to the employee. It need not be only where the salary of where the services are rendered. Salary may accrue to the person first and foremost where his salary becomes due. Where does the salary become due? Where exactly the employment contract is made, where it is actually paid to him, where he probably has to report to the employer. If that be India, for example, say for example, an expatriate employee of an Indian employer, if he is to bring it to tax, then probably that income may remain taxable in India. If that expatriate has to still, or rather that non-resident has to still, receive his salary in India, or even if not receive, the salary is supposed to be accruing or doing or becoming due to him in India because of the employment contract, because of the responsibilities which so this is an important point which one must note. It becomes equally important when you deal with certain non-resident cases. I think I will bring out this, Mr. Y is a non-resident employed with an Indian company. He renders services in Hong Kong and receives salary in Hong Kong. Salary accrues in India under Section 5(2). Employment in India. You don't have to say that no, because he's rendering service abroad, he will not be taxable at all in India. That is not the case. In my view, salary becomes taxable in India, though earned and received outside India. But because the employer is in India, the employment contract is in India, it becomes due for him to payment in India. There are certain decisions on this. Fraizo Sararak and PG Pantale, SG Pantale decision. You can refer to them, and there is a decision of the Supreme Court also in Gloria, where there was a reverse scenario: an Italian employer with an employee who had come to India. Again, they say that no, the Italian employer is essentially the employment is based in Italy, therefore taxable. Now, reverse the scenario: if the Indian employer is there, then obviously the taxability will remain within India. Ganesh, you want to add any point here, or do we proceed?
No, I think we should proceed.
Okay. So this is briefly bringing out in the table what happens to a person who is an employee who is a resident in India, how his income becomes taxable and where he can claim a tax benefit. And similarly, a table which brings out what happens to a non-resident employee. These have been dealt with us in our earlier presentation on section 9. So please refer to that, or you can obviously refer to this table itself. As far as accrual versus receipt goes, please bear in mind that there has been an issue as far as when you go to a case where recently we have seen many cases where a person is stuck in India due to COVID-19. So, for example, Mr. Z is a non-resident who is employed with a Singapore company. He does also the service in Singapore company, receives also salary in Singapore. Obviously, none of it is taxable in India. However, he has come to India in March 2020 and suddenly the lockdown was announced. He has got stuck in India. and he has been in India since then because Singapore has got very strict norms before for allowing anybody to come back into India. Sorry, to come back to Singapore. So in what has happened in that case is that he has spent for April 2020 to March 2021, he has spent exactly 365 days in India. Obviously, he has not been able to travel out of India. What do you do then? He has earned salary outside India on rendering of services. He earned salary outside India. His salary is still received in Singapore. His services have been rendered in India. Okay. Now the only issue was in this kind of cases, obviously 912 covers that if your salary is earned in India, you are squarely taxable in India. Your salary is taxable in India. However, there were certain exemptions available under the TT, especially on Article 15 relating to dependent services, where you actually on employees who are here for short visits to India could get away because unless they had a PE in India, or the employer had a PE in India, otherwise on short stay, which was generally 180 days, a person could say that if he has come to a service, employee has come to India, rendered services for less than the threshold period, then those salary would still not be taxable in India. This is only by way of a treaty. Unfortunately, now what has happened is that because of the persons who are stuck in India, they have got no relief. You recently, if you have heard of it, the income tax department has come back saying that there is no particular relief for such people who are stuck in India because probably other countries are also not giving as such any major reliefs. So Indian government has said that we will also not be providing any relief unless the person is a dual resident. When does a person become a dual resident? He becomes a dual resident when he is a resident of Singapore, for example, in this case, and India. You must know that every person does not automatically become or remain a resident of that foreign country. Here, for example, for Mr. Z, he was an employee of a foreign company. Whenever he was in Singapore, he was clearly a resident of Singapore. He was a non-resident of India. The tables have turned once he came to India and got stuck here. He spent 365 days in India before he becomes a resident of India. He probably could become not ordinarily resident, but he would still remain a resident, but not ordinarily resident. And he remains a non-resident of Singapore because Singapore also has a number of days test, which means he is only resident in India. He is not a dual resident. Therefore, he gets no treaty relief. Now, what happens in this kind of a scenario is that an NOR, you would probably say, does not liable on to tax on his foreign income. Please bear in mind that Section 912 does not talk about residential status, does not give any relief to a person who is a non-resident or a not ordinary resident. It simply says that if the salary is earned in India by way of rendering of services in India, it remains taxable in India irrespective of the residential status. It could even be, that is the whole idea, right? They are trying to tax non-residents. So a not ordinarily resident also will get covered, even though his income is received outside India, it will still remain taxable on his salary income in India. This is a major issue. A lot of employees who are locked down here or put in lockdown here are facing this issue. Unfortunately, no relief from the department or the government. The only problem is that a couple of NRIs are obviously on certain similar footings have gone into litigation with the government. The matter is still not heard. Supreme Court had said that the department has to come out with a circular. Unfortunately, there was no relief provided by the circular. So now it will only be when the Supreme Court finally says, and if they provide any relief, then so be it. Otherwise, there is an issue as far as salary which is earned in India of people who are stuck in India. I think 912 I will finish over here. 913, Ganesh, you would like to?
Yeah. Any questions on
Yes,
912?
I'll just check if there are any questions. Yeah. Salary which is accrued outside India to a non-resident and non-resident is located in, say, USA, but received the salary into his bank account in India, whether his salary is deemed to be received in India and taxed in India. To my understanding, the deeming provision is not in place here. It is received directly in India. If the salary is received for the first time within India, it is received in India, simply taxable under Section 5. The only relief would be that whether that person under the treaty can say that because he was a non-resident, because he was located in USA, he rendered his services in USA, prima facie, I don't think that the income will be liable to tax as per the treaty. But as per the Act, there is no relief. If you receive for the salary for the first time in India, there is no relief except for those who are on merchant ships and those who are traveling on ships for them certain reliefs were brought in. I believe that might have been covered and when the session speaker took on section 5. But at present, there is no other relief except for those seafarers who are traveling on ships and they being nomads. Nomads meaning they are non-resident of every country across the world, non-resident even of India, but they need some country to receive income. Obviously, they can receive only in India because they're citizens of India. They can receive it for the first time in India. Only they have been exempted under section 5, not otherwise. Yeah, I think that is the only question here. So I hope I have answered that to the satisfaction and we can move on then, Ganesh.
Okay. So, Rutvik, I'll take up 913.
Yes, yes, please. Should I?
You have to do the,
should I
yeah, you have to
give
do
you
the
the
sharing
rights?
of this. Yeah, no, you do it. No? So I'll ensure you don't leave.
Yeah, sorry.
To ensure that I don't leave, that you don't leave.
No. It is a joint presentation. I think hopefully you also have a cup of tea so that it's joint in
I'll do that.
joint in beverages also. Okay, sorry, I assigned the rights to you. I'm so sorry. I thought you wanted
You
to
did.
assign it back to me if you would like me to take it flow.
I'll do it. Take care of it. Share
Sorry.
screen. No?
Yes, yes. Yes, but we can see. Yeah, now we can see the presentation. Can just put it in the presentation mode. Yeah.
Okay. So we are on 9.1. There are some not so significant provisions. So we'll just rush through them. So basically, we have salaries to government servants. Now, salaries to government servants are deemed to accrue or arise in India as long as the government servant is a citizen of India. So basically, the idea is like you have your consular officials and diplomats and people from the government going abroad. They will be taxed in India on their income, even if they render services outside India. This will not include, obviously, foreign governments, employees of foreign governments. We are only talking about Indian governments, which includes union and state government going by the General Process Act. Perquisites and allowances paid to those employees abroad are exempt under Section 10. So let's proceed further. 914 dividends. Now, status of accrual of dividends is something one has to reflect upon. It is not where the company is. It could be different from the status of shares. It could also be contractually determined at a different place than where the contractually, or for that matter, why contractually, I would say by the resolution of the company can decide that the dividend shall be paid outside India. In that case, the amount accrues outside India, which is why this clause has been brought in. That if it's a dividend of an Indian company, it will be deemed to accrue or arise in India, irrespective of where the dividend actually accrues. So the status of shares and the status of accrual of dividend could be different. Is the point which comes across by the existence of this provisions of 914. And of course, dividend from foreign company, basically when I'm looking at a dividend, I have to look at the dividend from the company from whom I'm receiving the dividend, and the status of that company, and not the components of income from which the dividend is being paid to me. So really, it is a direct dividend which I have to see, not indirectly from Indian companies. So in this case, there's a case, AR ruling, where dividend from a foreign company, which had received dividend from its Indian subsidiary, was held to be not covered under this clause. Let's proceed. Now, one apart from business connection, the one other pillar, if I can call it that, pillars, a significant portion of Section 9, which we need to understand to really can you headway in international taxation. Now, 915, 6, and 7, they contain interest, royalty, and fees for technical services. These were introduced in 1976. Now, this is actually extending the accrual to certain other aspects, certain aspects of these income when they are being paid by the government. Government, as I said, includes union and state, or a person who's a resident or a person who's a non-resident. There are different conditions in all the three. If, as long as the payer is a government, it will always be deemed to accrue or arise in India in all the three cases: interest, royalties, and FTS. While in case of a person who's a, if the payer is a person who's a resident, we're talking about a payer, and if the payer is a person who's a resident, it will always be deemed to accrue or arise in India, except in certain cases. Now, what those cases are is basically when that interest, royalty, or FTS is utilized for the purpose of a business or profession carried on by such person outside India, or the payment is for the purpose of making or earning any income from any source outside India. Why did a columnar slide on these resources? To bring out the similarity. Largely they are similar, though there is one or two exceptions to a similarity. So that will come out in the slide. So now if you look at the provisions of clause B of subclause B of clause 5, which is person who's payer who's a resident, in that case, you would find for interest and for royalty and for FTS similar provisions under all these clauses. Now, I call this limb 1 and limb 2. The reason is that is how it has been addressed in certain cases. So it's easier for me to also use those terminology. So I'll call where the right property or information is used or utilized for the purpose of business or profession carried on by such person outside India, 1, and for the purpose of making or earning any income from any source outside India is limb 2. So now we look at the next provision, which is subclause C. A person who is a non-resident. If the payer is a person who is a non-resident, in that case, the rule is not an exception as we found in case of a person who is a resident. Now this becomes the rule. If the royalty is payable in respect of right, property, or information used or services utilized for the purpose of a business or profession carried on by such person in India. So this brings out the nexus with India, and that allows India to tax that income. The nexus is determined by the law. The payer, even if he's a non-resident, if the royalty is being paid for property, right, property, or information utilized for a business in India carried on by him, in such a case, it will be deemed to accrue or arise in India for the recipient of that income. Similarly, if that right, property, or information is used for the purpose of making or earning any income from any source in India, in that case also, the income is deemed to accrue or arise in India. Now, for clause 7, which is FTS, if you see, the words are slightly different. What they say? They say, I've highlighted that portion. It is utilized in a business or profession carried on by such person in India. Here it is utilized for the purposes of business or profession carried on by such person outside India. It is utilized in a business is what FTS says. But I believe effectively there is no change between the two. There has to be an existing business. You cannot have, there's an existing business which is contemplated under this limb. So in all the clauses, clause 5, 6, and 7, in case of a business which is being contemplated, this clause will not apply. Similarly, if you see, in case of a person who's a non-resident, the second limb is absent in interest. So for the purpose of if the interest is payable by the non-resident in respect of any debt incurred or money borrowed or used for the purpose of making or earning any income from any source in India, it is not deemed to accrue or arise in India. This has been brought out in the circular also. Example, to understand this limb 1 and limb 2 and the difference between the two limbs, the circular is a very good source of information. Now, what is that difference between limb 1 and limb 2? In limb 1, where I carry on as a payer, I carry on the business myself. In limb 2, somebody else carries on business for which I for which I'm making the payment. Like for instance, if you let us look at this next slide, then that will bring this aspect out better. Where right property or information is used for the purpose of business carried on by the payer. Like if I have my own business, I'm carrying it on. In that case, it is limb 1, where it is not used by the payer himself for the purpose of a business carried on by him, but it is sub-licensed to another so as to make or earn from a source. So basically, here somebody else is utilizing that right property or information to earn income or from any source in India or from a business in India, while I get income from licensing. Now, how would this work out in case of interest? Interest is basically, let's say I give money, I borrow as a payer, I borrow money and invest in a company in India and earn interest. In that case, I've earned income from a source in India, which is not covered under the provision. If you see that second clause is second limb is that limb 2 is absent in case of clause 5. So I am a non-resident. I earn interest. I pay interest to another non-resident from a borrowing which I have done. But that borrowing I've not used in a business in India myself, but I have given it or lent it onward to another person to earn from any source in India. Basically, in that case, it will not be deemed to accrue or arise in the hands of the person who has lent that money to. So here we are, when I'm looking at it, the person in this case is a payer, the government as a payer, a person who's a resident as a payer, and a person who's a non-resident as a payer. Their status and their utilization will determine the income in the hands of the recipient. So now in case of limb 1, in case of a payer is a resident, both limbs have to be satisfied for the exception to apply. And in case the payer is a non-resident, for this rule to apply, either limbs can be satisfied. So the idea is for the exception, which is for the payer as a resident, either limb you get accepted. The non-resident recipient will not have income deemed to accrue or arise in India. While in case of a rule, you will have either of the limbs satisfied. It will be deemed to accrue or arise in India. A business carried on need not the whole business, even a part of the business will satisfy this proposition, which is actually quite wide, it's wide in expanding with this interpretation, which is a very quite recent interpretation in case of Qualcomm by the Delhi Tribunal. The burden of proof will be on the person who's making the claim. So in case of an exception, it is the assessee who will have to prove that the exception applies in subclause B, which is when the payer is a resident. And on the revenue to prove that subclause C applies, that is when the payer is a non-resident. Now in all this, we talked about source. What is that source? Is been defined by this judgment of the Allahabad High Court, which is very oft quoted in several decisions as the spring or fount from which a clearly defined channel of income flows. So that is your source. There are instances on case laws from which have culled out from the case laws, so that we understand a little about the way in which these limbs, limb 1 and limb 2, are interpreted by the courts. No proposition comes out, but these could be useful indicators to understand these limbs. Now, what does it say? For identifying overseas customers, this was a case of an FTS. For identifying overseas customers for products to be exported from India, locating prospects and promoting assessees' capabilities to sell their products in India. Was sales by the payer to customers outside India was affected from India. So services were utilized in India. It was held that the payer who's a resident was paying to a US agent or US commission agent or US consultant to do all these activities. The recipient of income was a US national or US resident, and his income was held to be deemed to accrue or arise in India by the operation of limb 1. That is your clause, subclause B, 917B, limb 1. Now, next one
I
is
think-
testing services for, sorry.
Sorry, Ganesh, sorry to interrupt.
Yeah.
But I think this is the kind of a case where a commission agent may, who's providing more services will get covered under FTS, and that
Yes, yes.
exclusion under
This is-
explanation 1B will not be available.
Yes, yes. One has to be careful that if I'm a commission agent and I'm only doing a sales activity, then I get covered under, I do not get covered under FTS. In this case, the person did a lot of things. He was an expert in the industry, and he was to do a lot of technical aspects of the sales. So then thereby it was held it was FTS. There was no doubt it was FTS, and was services of that consultant was utilized in India, and it was held that income was deemed to accrue or arise in India of the US party. So testing, now this was another one. Havel's case is a very famous case, or Delhi High Court upheld the tribunal ruling saying that the testing services for export market, source of income are contracts which are included in India. So in this, what happened was there were some testing services being conducted by a foreign party for selling in those markets. But the High Court held that the importer of the goods is not a source of income, it's only a source of receipt. And services cannot be held to have been utilized in earning from a source outside India. Havels as a taxpayer did not argue that it was utilizing the services for a business outside India. So the business was all from India. The manufacturing was in India. The export contracts were also concluded in India. So really what happened was the testing was done outside India. So now there they said it is not enough. The testing just exporting from India, you don't create a source outside India. The importer is not a source. He's only a source of the receipt of money and not a source of income for the Indian party, the Indian payer, that is Havels, which is why the income deems to accrue or arise to the non-resident in India. Then the next two bullets are very interesting, which is why I put them in. Services were acquired. Services, legal services actually, were acquired for acquiring a sugar mills in Brazil. And a Brazilian subsidiary was set up. The SSA was contemplating to create a source. This was enough to covered within the phrase for the purpose of making or earning income outside India from a source outside India. So it doesn't require an existing source. This is a point which came out in this judgment. Basically, I don't need to have an existing source as long as I contemplate a source. But for the purpose of a business, I need to have an existing business. Otherwise, I need to have a pre-existing business. Otherwise, that will not apply. So there is a differentiation between limb 1 and limb 2 is one. This differentiation looked very interesting to me. See, which is what come out in the next one, Shriram Capital's case. Legal is connected to the proposal to acquire an overseas business by a resident, not being a pre-existing business, not excluded. So here they were going for the exception as a payer, Indian payer being the payer being a resident person, and the exception was held not to apply because there was no existing business. You're going to go abroad to acquire a business, and the services were meant for that activity. So these limb 1, limb 2 combination and leads to interesting results. One other point we need to bear in mind is these exceptions and rules are not there in treaties. So you could have a situation where the act is more beneficial than the treaties. Like you have a situation where a payer is a resident, the exceptions apply, the income of the non-resident will not be deemed to accrue or arise in India. But under a treaty, the payer being a resident, the treaty will give taxing rights to India only, because the payer being the source of the income for the non-resident, it would be India where the payer is. So this one point one has to keep in mind, that it is quite possible that the act would lead to a more favorable result for the non-resident taxpayer than the treaty. It is not always the treaty which is more beneficial. Now we also have this explanation to Section 9, which was brought in 2007 and substituted in 2010. Basically, what it says is it doesn't matter. There are certain aspects which are irrespective of these aspects. These aspects are not relevant for understanding whether income is deemed to accrue or arise in India under clause 5, 6, or 7. What are these aspects? That the non-resident has a residence or a place of business or business connection in India. Now let us stop here for the moment. Limb 1 itself tells you the priority of application between 911, 916, 915, 916, 917. Even if there is a business connection in India, you apply the special clause, that is lay specialist, which is 911, which is 915, your royalty, interest, royalty, or FTS 5, 6, and 7. So there's a legal backing to for this lay specialist proposition. Business connection being more general than these specific provisions. The second limb was brought in 2010 to nullify Ishikawa-jima, the case of the Supreme Court, where the court had held that FTS is only when services are both rendered in India and utilized in India. Though that is not the real, that's not the plain, that's not what comes out from the plain reading of 917. But this is what was interpreted by the Supreme Court. But to nullify that, they brought in that it doesn't matter whether non-resident has rendered services in India. But please bear in mind, it is not, this subclause 2 is not talking about the utilization. Utilization is one of the important aspects in your limb 1 and limb 2, and that utilization is from the perspective of the payer. While here, non-resident rendering services is from the perspective of the recipient. So the utilization aspect by the payer is nowhere affected or impacted by insertion of this explanation. So whatever we discussed on the source rule for limb 1 and under limb 1 under 5, 6, and 7 of section 9, which I labeled as limb 1 and limb 2, will continue to apply even after explanation to section 9. But as I said, these are irrelevant factors, need not be, this does not impact the source rules which we discussed under those clause 5, 6, and 7. So this is fine. What about the specialty aspect we have discussed? Only one point I'll raise on this. The last limb, rules relating to specific category is self-contained. Now, basically, let us look at both the limbs. If a particular item falls out of the definition of royalty or falls out of the definition of FTS, in that case, there is no bar on examining 911, the business connection. But if it is falling within that definition, but it falls out of the containing the source rules. Like basically, I'm talking about 916 ABC. Falls under the exception for a payer being a resident. So in that case, you don't go back to 911 because the particular income fell under the head, let's say royalties. It was as per the rules contained, as per the provisions contained for royalties, it was not deemed to accrue or arise in India. Then there is no occasion to again go and look at 911 to see whether there's a business connection there. Right? But if, let us say, it is not at all, or it is not FTS at all, in that case, there is no bar in going and looking at 911 to see whether there is a business connection, whether there exists a business connection. So this is one aspect, important aspect, which I thought I'll bring in. What is the priority in application of various clauses of 9.1? So 9.1 is nothing but a collection of deemed accrual rules in the Act.
But this situation will change with SAP now in the picture, right?
I don't think so.
Oh,
I don't think so. Because what does SAP do? It says SAP shall constitute business connection. That's all.
And this still limits a special. Yeah.
Not necessarily, no. So, but no, the point is, in case of our FTS payment, let us debate this aspect. What does SCP says? SCP says transaction in respect of goods, services, or property. Let's look at the FTS. What does it say? Consideration for entering of your technical, managerial, or consultancy services. So now, think is specific. I would believe the later one is more specific than the earlier. I would believe that nothing changes. Things will remain as they are. Yeah. Anyway, that's my view. Of course, others can have different views, and Rutvik, especially you can have. It helps us debate further, no?
I understand. Yeah.
So now 915. Let us, after discussing the common understanding for 5, 6, and 7, let us look at individual portions. 915, interest. So the interest is basically defined under the Act. We'll not spend too much time on it because it's largely provisions are, once we understand source rule and once we understand what interest is, there's nothing really, nothing will detain us from coming to a conclusion. Only, as I said, it is defined under the Act is very wide, which includes everything, even service fee or other charge in respect of monies borrowed or debt incurred, in respect of any credit facility which has not been utilized. So it will include everything and anything contained to an interest related to a debt incurred or money borrowed. So we have discussed, we'll skip that. And as this point, which I said about the circular of 1976, the limb 2 is absent in the source rule of for clause 5 for interest. So if NR A borrows from B, also an NR, and invests in shares of an Indian company, interest receivable or dividend receivable by B is not deemed to occur as in India. It's a point which is coming. So a lender is not affected because the source of income is in India for the borrower. Now there was an expression inserted in 1416 for banking companies. Basically, they brought in the explanation was basically to nullify certain court rulings which said that an interest paid by a firm establishment or branch to its head office abroad is interest to self. So there will be no TDS provisions. And no income also will accrue to the head office. Now that, to nullify that, they brought in this explanation to say wherever interest is paid by a permanent establishment of a foreign banking company in India, in that case, it will be deemed as not payment to self, it will be deemed as payment to another person, and the income of the permanent establishment will include will include the interest which it pays to the non-resident, which in effect means that a P of a non-resident, if it pays interest to its head office, it has to be considered as non-deductible, or in effect it will be non-deductible. In effect, what will happen is the interest paid to the head office will be added to the profits of the P. In effect, it cancels out. That is the impact of this provision. Now, the reverse is not covered. The reverse is basically, let us say, income is earned by the PE from the head office. That is not covered. Probably now one can still take recourse to the old the case law what we discussed about payment to self and say this is a payment by head office to the PE as interest will not be covered. But I have a little misgiving about this sort of an interpretation, because branch and head office to be considered separate for computing profits of the branch. So when I'm computing the profits of the branch, I would need to take into account interest from the head office. Otherwise, my profit computation will go faulty. But as I said, if you just income earned from self, we have a credit loan case in Mumbai Tribunal which said the same thing. It is not taxable. But as I said, I have a little reservation on that. So 916, we have come to royalty. So now what does it say? Royalty is defined in explanation 2. We'll take that. We discuss the source rule. We don't have to. This does not detain us any further. What does explanation 2 say? Explanation 2 is a list of 5, 6 clauses which contain several items of intellectual property and other property, which payment for which or payment for the use of for which will constitute royalty under the Act. So royalty means consideration, including any lump sum consideration, but excluding any consideration which would be income with the recipient under the head capital gains. So capital gains will not be considered as royalty. What are these clauses? Transfer of all or any rights, including granting of a license, a patent, invention, model, design, secret formula, process, or trade name, or trademark or similar property, or of use of these properties. So basically, transfer of all or any rights, including granting of a license, and for the use of these properties will be covered under the definition of royalty. One thing which you need to keep in mind is we can of course go through all these lists, but I think it is really not required. What we need to look at is two important aspects in explanation 2, which is a point of interest to me. One, it includes rendering of any services in connection with these activities. So basically, it is not that royalty and FTS, which is a service in connection with any of these activities contained under explanation 2, will still be royalty and not FTS. So one has to keep that in mind. This will have an impact because both are taxable in India. This will have an impact because of the exceptions available under FTS, which are not available under royalty. Like which exclusions I will take you through. But the point is, the rendering of any service in connection with any of these intellectual property will be considered as royalty only and not FTS. So I will say priority is I will give to royalty in terms of characterizing as such services, while FTS is a general provision vis-a-vis royalty. So vis-a-vis services for any intellectual property, which will be royalty, FTS will be a general provision, and I would say it will be items which are not covered under this subclause 7. Subclause 6 is what will be covered under FTS. Another aspect which I'll bring to your attention is it talks about a consideration. So what we're talking about is a quid pro quo in any contract. What is that the customer pays for will have to be taken into account while determining the characterization. We simply jump to one of these limbs and say it fits under this or fits under that. No, we need to understand what the contract is for, why the consideration is being paid, and accordingly determine the characterization. It might for all for as an example. Let me give you. Let us say I pay AMC for repairing of my air conditioner. No, that's a technical service. It is not related to royalty, but it is related to FTS. But the same logic will hold good. So, if it is, what did I pay for? I pay for a maintaining of my AC. It is not specific to. It is not a very. Though it could be a technical activity which is being done, it might be. It is actually a routine maintenance which is happening. So a routine maintenance is not FTS, though use of technical services might have happened by the technician who does maintenance of the service. So basically, what did I pay for? I did not pay for getting any technical service from him. I paid for getting my routine maintenance done of my equipment. So this is one example where this word consideration has to be taken into account while understanding the characterization. What is that payment being made for? So it will be customer centric. The focus will be on what the customer is viewing the transaction as, and not what the recipient is earning for. Now, there's one other point here. Not all are intellectual property, intellectual property items. You have what is called use of or right to use any industrial, commercial, or scientific equipment. So here, this is basically if somebody leases out their equipment, it will be falling under the definition of royalty. This is one aspect which people would have come across even in domestic taxation under 194, 194J, whether it should be under this section or under 194I or 194C. So this is one aspect which one has to keep in mind. Not all are intellectual property. For use of equipment, we have there are several explanations which were brought in 2012. Uh, Expression 5. So talked about control or possession need not be with the payer. The right property of information need not be directly used with the payer. Location of such right property of information need not be in India. So these are the expressions that are brought in to nullify AsiaSat case, which had said exactly the same. So these provisions were brought in. Now, one other explanation was brought in was explanation 6 relating to process, which said the process includes. Okay, the debate was secret formula or process is the way the provision is worded. Secret formula or process is the way the provision is worded. It's always been challenged by the government department that the word secret does not qualify process. So even if a process is well known and it is in the public domain, it will still be the payment for the such process will be constituting royalty. Now to nullify that, of course the court said otherwise. To say secret formula or process, secret is qualifies both formula and process. So then to nullify that provision, they brought in this explanation to say process includes and shall be deemed to have always included transmission by satellite, etc., 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 whether or not last few lines, whether or not such process is secret. This was brought into plug. It was said that explanation 5 is clarificatory. Control and possession is not necessary. It's a lot of it's a very involved decision, but I tend to intuitively it appeals to me, though of course it's been criticized quite widely in the tax circles. Second is our MasterCard. Now the one it's an AR ruling where they say the taxation technology used to provide banking services which are patented, there's a technology that is which is patented, not known to public, is a secret process, which I find odd, because for a patent, for one to get a patent for a technology, you have to disclose it to the public. That is the whole purpose of a patent, that you disclose the technology. It's available in public domain, but can't be used by others. But it develops future inventions and future products. So a patent and a secret process are mutually exclusive according to me, but they are misconstitute patent to be a secret process. So what these are aspects which will come out. Data storage charges are not for the use of equipment, and provision now this standard services. This is one other difference which keeps coming up. Whenever I do something, I take a flight from, of course, after the pandemic gets over, I take a flight from Bombay to come to Bangalore to meet you all. What have I paid for? I paid for a ticket. Now, have I paid for a technical service? That's the question. Now, let us say I paid I chartered a flight. If I, of course, buy a ticket, I can say that I have got just a service of being transported from A to B, from Bombay to Bangalore. Let us say I charter a flight and come there. Now, is it the operator, the flight operator, is using technology to transport me from point A to point B. But the use of technology is not what is relevant. Here, if he's giving a standard service, of course, chartering of a flight might not be standard, but it's an example. If he is giving standard service, in that case, it is a facility which is what is given. It cannot be a technical service. This is a view which was given in the context of FTS under the SkyCell's communications, but also it can be used for royalty to say provision of bandwidth services, which is a standard service, is not for use of equipment, so it is not royalty. As I said, use of equipment falls under royalty, while a standard facility or a standard service falls under technical services. But as long as it's a standard service, there is no use of equipment. Like an example of the flight which I gave you, let us say I take a flight from Bombay to Bangalore. There's a standard facility, standard service which the airlines is giving me, and it is not for a use of equipment, and it cannot also be a technical service in simple words. So software, of course, like everybody is like aware of this case. So now in software, what happens? So we had a big controversy in software taxation. So we don't have to go into that. Largely, this got settled, or at least people believe it got settled by the Supreme Court and Engineering Analysis Center of Excellence case, which came out in March, where the court held that the use of computer software is not use of copyright. This was one of the major contentions of the revenue in Samsung, in Citrix, Synopsys International, where they said use of software or use of a copyrighted product is use of copyright. The court nullified it, which is a very welcome move. It was a wrong proposition of the department to contend in that fashion. Next would be next contention was no use of copyright by distributors of shrink-wrapped software is one of the contentions of the one of the conclusions of the Supreme Court. Now, when I buy software or buy copies of software from the non-resident provider and sell it to the Indian market, the money which I make, the payments which I make to the copyright owner abroad for copies of the software is not royalty, is what Supreme Court held. And the other point which Supreme Court held was explanation 4. Explanation 4 is not retrospective. It's another point which Supreme Court held. Explanation 4, what does explanation 4 say? Okay, I don't think I will copy it. Okay, explanation 4 says that use of right for use or right to use computer software is a right property information covered under clause 6. That is royalty. Is what explanation 4 said. So now there was a debate. The taxpayer argued that explanation 4 does not amend explanation 2, which defines royalty. So it should not be read into explanation 2. But the Supreme Court negated that thought process and held that there's nowhere it's mentioned the right property information relates to right property information for which royalty is being paid. So explanation 4 applies squarely to explanation 2, but it cannot be retrospective as was sought to be brought in. It was to be from 1476. The court said the provision, the word computer software, the term computer software was legally recognized only in 94 when some act was brought in. So obviously you can't say it, the explanation 4 dates back to 1476 when there was no mention of computer software. So this was a good ruling vis-a-vis explanation 4 not being retrospective. Same logic can be used for explanation 6, but I'm not sure for explanation 5 because explanation 5 is generic about right possession and control of equipment. So that reasoning which was given to say explanation 4 is not retrospective, that reasoning is not available for explanation 5. So it can't be a standard principle that expressions can't be retrospective. One has to see individual aspects and then take a call on this. Some questions are coming on EL and SCP. We'll take that up now. Interplay between all the three. The next is online. There are certain instances which I'm dealing with. There are, of course, plenty of instances. We can go on only on royalty for even the whole day is not enough. Idea is just to give a flavor about these characterization issues. The idea is not to develop any fundamental principles or first principles on which one can determine all this. So basically, one can only narrate these case laws. And of course, there are specific case laws or there are comparable facts. One can try and rely on these case laws or distinguish the case laws depending on which side of the table you fall in. Online advertisements was held to be not to use of equipment. The website is not an equipment, is what was held in Yahoo India. Sponsored searches and banners, again, though there's a use of technology which is patented, it is not royalty. It was what was held in Right Florist. Google AdWords involved use of patented text and secret process use of trademarks. Was what held in by the Bangalore Tribunal. The High Court has remanded the issue back to the tribunal to decide the matter afresh, because certain evidences on which the tribunal decided, was not placed before the taxpayer for rebuttal. So it was not on the setting aside of the order is not, or remanding it back to the tribunal is not based on merits. It is based on natural justice. Film rights is basically about cinematograph films. Is held that it is for perpetuity. It is not royalty, because that time the sale, distribution, or exhibition of films was available as an exclusion under 916 exclusion 2 subclause 5. So perpetuity aspect is was decided in Balaji Communications also as royalty, because it was not for perpetual period. It was only for 25 years. Database subscriptions on online and online information. Limited rights to use database is not use of copyright. It was what held in fact-check research. Is a very old decision. But one thought is like, the AR held as such. It's been very well. It's been followed. It's a right conclusion. But you tend to think, why did they even discuss use of copyright when I'm using a database? Let's say I'm using a taxman database. Why would that be copyright? I'm using a product, and I'm not using a copyright in the product. Similarly, then let us go further. That this thought buzz case was interesting. Information was supplied by social media monitoring through web crawlers. Web crawlers was throwing out information concerning industrial and commercial knowledge and skill, and so it was held to be royalty. The point is, this web crawlers were actually mining the World Wide Web to bring out information which was in the public domain. Only they were bringing it out in through an automated means. So how would it be information concerning industrial and commercial knowledge or skill? Is it leaves one nonplussed. The reason is, if it is an information concerning industrial and commercial knowledge or skill, it has to be confidential. If it is available to everyone, then how it can be an industrial and commercial knowledge, and the skill would imply it is related to the person who's giving you that information. It's specific to him. So here you have a web crawler who goes all over the place to dig out data which is available in the public domain, but the AR ruling requires, I would believe, a reconsideration. The next one is domain name registration services. Now here, surprisingly, this was held by Delhi Tribunal to be royalty. But here what we have, I think again they must have missed it out, missed the point that a registration of domain names are themselves trademark protected. So a person who's registering trade names is not giving a right to use the trade names. He's only a registering authority. It is like you go to a MCA website and apply for a name for a company or an LLP, something like that. So now, are they giving you a right to use a name which belongs to them? No. So you can go and register the trade name yourself independent of that registration, and give that trademark or trade name registration as a support for wanting a particular name to be registered in the registry. So, but here, unfortunately, the ruling held that it was royalty. The registration fee which go from the customers was held to be royalty. This patent we discussed, use of patented process aspect we discussed, MasterCard decision. After finishing 917, which is again a very short proposition, then we'll look at your EL, SCP, and royalty FTS correlation. FTS is defined in explanation 2 managerial, technical, or consultancy services. Source rule will leave for the moment. Explanation to section 2 we have already decided. It is for the consideration. Again, as I said, any consideration, it has to be, the quid pro quo is very important. Instead of jumping to the characterization, first understand what the contract says is what I would advise. For rendering of any managerial, technical, or consultancy services, including provision of services of technical or other personnel, but it does not include consideration for any construction, assembly. These are the exclusions. Last two, consideration, which is salaries. So we'll discuss these aspects in one by one. What has been judicially laid down is these words, managerial, technical, or consultancy, has to be viewed and has to be understood in common parlance. These are not legal or nomen juris or words of legal impact import. They have to be used under as normally understood. Managerial services, we have administrative management not automatically covered unless there are other aspects to it. Leadership training was held to be not managerial services. When I'm training managers, I'm not managing. So I'm training others to manage. So basically, this is what was held in scientific AB. And managerial services, even if of technical or consultancy nature, now here, this point is actually very important, that you will find a lot of case laws which would see that, where you would see the taxpayer wants to fall under managerial services. The reason is several treaties do not contain managerial services under FTS or under what is called fees included services. So they want to fall under managerial services and fall out of the Article 12, and then in the absence of a P, they will not get taxed. But under the domestic law, managerial services need not be of a technical nature. While under fees for included services under treaty, you have a make available clause, so which brings out the need for managerial services to be not making available unless they make available any technology, any technical knowledge or skill will fall out of managerial services. So that aspect one has to keep in mind. The managerial services under the Income Tax Act under Section 917 need not be of a technical or it need not be a technical or a consultancy in nature. It can only be standalone managerial services of any nature will be covered. Now, technical services, of course, requires expertise in, or there should be technology involved somewhere. In Bharti Cellular, it was held that that requires human intervention, because technical has to be seen within the context of managerial and consultancy, both of which require human intervention. Without human element, human agency, you can't have a managerial service or a consultancy services. So, Bharti Cellular held, by the same token, even technical services should require human intervention. But this has been a little watered down, not watered down. This proposition has been given a little, as we use with caution, let me put it like that, as Supreme Court held in Kotak Securities, 2016, 383 ITR 1, where Supreme Court said that this human intervention aspect has to be cautiously used, especially when in the today's development of technology, scientific and technological development, there could be a fully automated process. It could be technical service. So where there are fully automated, you could have you would still need to see whether there is any other basis by which you determine whether it is FTS or it is not FTS, whether it is a technical service or not. So only a human intervention as a basis could be fallacious, where the entire process is automated. One has to see other aspects. This was in the context of a stock exchange. I think this is Mumbai Stock Exchange only, or a Bombay Stock Exchange. And the stock exchange fees which are being paid by the company was held to be FTS, technical service, by the tax authorities. And there, the Supreme Court says that though the services are fully automated, these services were available to all the members of the stock exchange. So there was nothing special, exclusive, or customized in that service which was rendered by the stock exchange. Technical service like managerial or consultancy would denote service, seeking of service to cater to special needs of a customer. It cannot be a standard facility available. It has to be a special need of a customer, which is for which the customer makes the payment. As I said, the word consideration again comes into play here. And unless it is specialized, exclusive or individual requirement of the user, it cannot be a technical service. This is another basis which the Supreme Court has brought in Kotak Securities. It is not that human element has been fully given the go by. All this is in case of where fully automated services, you need to see other aspects, whether it is a facility which is being given or a service which is being given. So this is a very important case one needs to keep in mind when one wants to understand FTS. So then let's proceed further. Consultancy services, as I said, includes an advisory service even without technological services like managerial services. Like managerial services, we discussed that it need not be of technical nature. Same way, consultancy services also need not be of technical nature. Under the Act, under treaty where your FIS is involved, you could have a different conclusion. So one has to, when one looks at Section 9, one looks at this as these are services in common parlance. A consultancy services, even without technological expertise, could be a FTS, could be a consultancy services falling under FTS. So we discussed this FIS aspect, which is there in the next bullet. So then let's proceed. This is an inclusion in the FTS definition. Includes provision of services of technical or other personnel. Mere manpower supply will not be covered in this. There has to be something. The consideration has to be for something technical in nature, which is being provided by the service provider. This is what was decided in Zuari Agro Chemicals. So it should be, when I'm just giving personnel, it will not be an FTS. It will not fall under this, including provision of services of technical or other personnel. And I'm also giving something along with the personnel. I'm also taking responsibility for certain technical services. In that case alone, this clause will apply. Consideration for any construction, assembly or mining, or like project. This is another exclusion which is available. Why is this available? Why was this even brought in? Is basically to this activity of construction, assembly, mining, or like project will be in India. It is something akin to manufacturing, or it is something as intense as a manufacturing or a trading activity in India. This in the normal course will be covered under section 5 direct accrual. To make it clear, they have brought this provision to say that this will not be FTS. But one has to bear in mind that if you do only a supervisory activity as a non-resident, without undertaking the specific construction, assembly, mining, or like project, you will not be covered. Supervisory services will fall under FTS. It will not get excluded. Similarly, installation of equipment belonging to a customer, it is not necessary that the equipment should also belong to the non-resident who is doing the construction activity. As long as the activity is related to as long as the activity is being done by him, the construction activity is being done by him, who the equipment belongs to is not relevant or not important. Make available and all that we leave for the moment, because anyway this will be covered in detail by the speakers in the forthcoming sessions. So of course 115A is applicable to for payments from an Indian concern, and Section 44DA will not apply. Section 44DA is basically where NR has a permanent establishment in India and royalty and FTS is connected with that PE. In that case, the non-resident will be subject to a net basis taxation. 115A will not apply in that case. Where there is a 44DA is not where there is no permanent establishment of the non-resident in India, 115A will apply if the payment of royalty or FTS is from an Indian concern, or interest is from an Indian concern. If TDS is deducted as per the Act, no obligation to file a return. If some relief is being claimed by the under a treaty, then of course you have to file the return and claim the benefit. And Section 195, of course, there's a TDS obligation, being payment or non-resident. Now let us look at this interplay. So we have seen in SAP, we are talking about provision of download of software. Some question had come on that, I just saw briefly. So probably this will get discussed now. SAP contains provision of download of software as one of the aspects which constitute SAP, including provision of download of data or software. Now we also have EL, which includes online provision of services, online supply of goods. We have royalty and FTS, which we discussed all along, which you discussed. Now, in what priority we look at these things? Is there an option available to me to say I will be guided by EL and not by SAP, or I'll be guided by royalty and not by EL? Because if I'm guided by royalty, if the TDS under royalty, I might get a credit in the other country. If it is an EL, I might not get credit in the other country. So these are various doubts which come into our minds. So idea section or this portion of the slides is to delve into these aspects to see whether we can generate some understanding of these provisions. Before we go there, my conclusion is this: when I look at royalty, will always be the first item to earmark in a transaction. What is royalty or FTS will not be EL or SAP. EL or SAP will not get covered under that. If it is not royalty or FTS, then EL will apply. If it is not EL, then SAP will apply. So this is the way I'll go. I'll go through these portions and I'll tell you why I'm having this as the priority or path. Identify these in this fashion. Let's first take up software. Software is whether I should go for royalty or SAP. Now we have explanation 4 to section 916, which says right for use or right to use computer software as royalty, as held by the Supreme Court in engineering analysis. And we also have explanation 2A, which says provision of download of software as royalty. Now one is contract based. This is consideration for the right property information, or use of right property, transfer of right property information. While the second is against the mode of delivery, because it's all the provision of download of software. Now, question is, what will apply where? If it is a sale of software, explanation 4 should be inapplicable. These are, of course, my views, because explanation 4 talks about right for use and right to use. Why would I want a right for use or a right to use if I been sold the copy of the software? So obviously, I would believe sale of software will not apply in case of explanation 4, and explanation 2A will apply if it is a download. Same way, now going further, if there's a license of software instead of a sale, let's say I have a EULA and there's a license. Of course, even for a sale, you sign a EULA. Whether a EULA is a sale or license itself is a debate that we'll not get into now. I would believe that whether it is a sale or a license, you have to see, irrespective of the EULA, you have to see the contract between the parties, whether as a buyer, I come to own that copy. Whether I have the incidence of ownership over that copy is what I have to see. I don't have to see the EULA conditions to determine whether I'm the owner of the property. You will find EULA conditions which will tie my hands and foot, not permit me to do a lot of things. But as long as that copy which I buy from the software provider cannot be taken away from me, I would believe the incidents of ownership are in my favor. I am the owner of that copy. I might still have a conditions which I need to fulfill because I have signed that EULA. But that doesn't mean it is not a sale. It could still be a sale. So let us not go further into that sale or license debate. If it is a license, I will say both the explanation 4 and 2A will apply, because explanation 4 includes license as well. So then what? What is the priority? The priority would be lay specialist clause 6 meteor satellite, which says that I fall into 916 or 917. Then there is no occasion to look at 911. So we had a short exchange between Rutvik and me earlier about whether SAP is more specific or FTS. So I would believe SAP only delineates what constitutes business correction. I would still feel that your royalty or FTS would be more specific. And once you fall under royalty or FTS, no officer is going to allow you to get away with a net basis taxation, either under a net basis taxation under the SAP or 6% under EL. Okay, now this chart, do we have time to go through this? I think we'll leave this. We'll go to the next one. This is basically the same thing what I've explained, what will apply in this chart. Okay, this I think we should, this tells us the interplay between royalty, FTS, SCP and equalization levy. Now here, let us look at this slide here. Rutvik.
Yeah, Ganesh.
Hello. Yeah. I hope all are there.
Yeah.
I thought I was going too fast. Anyway.
No.
Any questions are there? So before, or should I finish this?
Yeah,
and
there
then...
are, but I think we can finish because this is, there was one question essentially on this.
How many more slides are there, sir? How many more time you will take? How much more time you will take?
Another 10 minutes.
Yeah, then you finish off and then take the question, sir. It's better.
Yeah. Okay. So anyway, what we have now, we are looking at the interplay between SAP, equalization levy, and royalty and FTS. What we have in the Finance Act 16, which contains the SAP provisions, is that there's a proviso which was introduced, which says that the consideration received or receivable for specified services which are taxable as royalty or FTS in India under the Income Tax Act read with agreement notified under Section 1998. So the figure, the words which I want to be highlighted, I've read. So you can focus only on those words. You don't have to read the whole provisions. So what is taxable as royalty or FTS is excluded by this proviso from equalization levy. So this is a provision. Section 163 proviso excludes income or consideration which is taxable as royalty or FTS under the Act, read with the agreement, read with the DTAA agreement. While Section 1050 tells you the income which is chargeable to tax as royalty or FTS, explanation to Section 1050 says that income referred to in this clause shall not include. That means 1050 exempts what is chargeable under EL, but it says that exclusion will not apply to any income which is chargeable to tax as royalty or FTS for technical royalty or FTS in India under this Act read with the agreement. So if you see, there is a similarity of wordings, though there is a slight difference. One talks about taxable as royalty or FTS. The second one taxable as chargeable to tax as royalty or FTS. I believe there is no difference between these two choice of words. Both mean the same thing. And now, if these two provisions explain that royalty or FTS will have priority over EL. Now, what is the priority? How will we read that priority? Now, let us look at the next bullet. Taxable versus chargeable. We discussed this. Now, what is taxable versus taxable or chargeable? What do we mean by that? Taxable as royalty or FTS in India under the Act. There is only one provision which under 115A, and income is taxable as royalty or FTS under the Act. Under 44DA, which is in case of a permanent establishment of a non-resident who earns royalty or FTS, it is taxable as royalty or FTS under the Act. In all other cases, it is not taxable as royalty or FTS under the Act. Now, it will be under other heads of income or under other items of income. It will be royalty or FTS. Now, once I determine that what is royalty or FTS under taxable under the Act, read with the agreement. What is the meaning read with the treaty? What does it mean? Read with the treaty, I don't have to go again to the definition of royalty or FTS of the treaty. all I have to see is whether the item of income which is taxable as royalty or FTS under the Act, does India have the taxing rights? That's all. So my interpretation of these words are, these read with the agreement implies the taxability of royalty or taxability as royalty or FTS in India under the Act, determined by the taxing rights to India under the treaty, will be what is subject matter of exclusion from EL as well as under the 1050 exemption. So if you keep this in mind and then look at this left table, it becomes the priority becomes very clear. Now we have decided it is covered. The one column talks about royalty or FTS under the Act, not royalty or FTS under the Act, and SCP. These are three heads. I have divided the columns. I have divided the table. Now, if treaty allocates taxing rights to India, I am not discussing whether it is royalty or FTS under the treaty. That I don't need to look at all. All I'm saying is whether treaty allocates India the taxing rights under either Article 12, which is relating to a royalty FTS, under Article 12 royalty, 13 FTS. I've just put the article numbers. You want us to see the specific treaty or other income article, and there is no P. So it could be any way in which the taxing rights could be with India. If it is with India, if it is resident to non-resident, the payment is made by a resident to a non-resident, then it will be royalty. It is royalty or FTS. The Act will apply. EL will not apply. So this is the clause. And of course, SCP will not apply because once royalty applies, 916 or 7 are lay specialists, SCP will not apply. That is a conclusion which I have come out with. Now, if the payment is NR to NR, if it is NR to NR, what the issue is, 115A talks about payment by an Indian concern. It's payment by a non-resident to another non-resident is not covered under 115A or 44DA. So it is not covered under, it is not taxable as royalty or FTS under the Act. If it is not taxable as royalty or FTS under the Act, Section 1050, EL will apply, Section 1050 will apply, SCP will not apply. So if it is NR to NR payment, you will not have a taxability as royalty or FTS in India under the Act, and you will go into EL provisions.
But EL would also apply only if the non-resident has used it through an IP address located in India and in those scenarios.
Yeah, no, I'm not gone into the qualifications of EL. I'm just not too complex as a table.
Yeah.
I'm just trying to say if EL applies, otherwise, what will be the priority of application?
Correct. Yeah.
Next is treaty does not allocate taxing rights to India. That means India does not have the taxing rights. In that case, there is no occasion to look at it is royalty or FTS, but it is not taxable as in India read to the agreement. So when India does not give the taxing rights, India does not have the taxing rights, then it is not taxable in India as royalty or FTS. In that case, 115A or 44DA will not apply. Then since it's an R to NR payment, EL will apply. And NR to NR payment also EL applies. In either cases, Section 1050 applies and SCP will not apply. Why? Possibly one can say once EL applies, why I'm saying SCP will not apply is basically because once EL applies, the income is exempt under 1050, then there's no occasion to look at SCP.
Sorry, but on the first part of R to NR, when royalty treaty does not allocate rights, but we are saying that under the Act also, royalty FTS is under Section 115A, 44DA. There also it does not apply because you are saying that EL applies.
So what happens? Like what happens is what is excluded under the proviso is what is taxable as royalty or FTS in India under the Income Tax Act read with the agreement. Your agreement says no, you don't have taxing rights. So it is not taxable as royalty or FTS under the Act. So this proviso will not apply. In that case, you go into the main EL provisions. Once main EL provisions apply, 1050 will apply. Exemption, the Indian Income Tax Act will have no role to play.
Yeah. So treaty allocates or does not allocate would amount to something whether their royalty is taxable in India or not, or meaning in that sense, right?
No, when I'm saying treaty allocating taxing rights, what I'm meaning is, this third bullet. Read to the treaty. Read to the treaty implies allocating of taxing rights. Allocating of taxing rights could be under any article. It doesn't matter.
Okay.
It could be under Article 12, could be under Article 13, which deal with royalty and FTS, or it could be Article 21, which deals with other income. It could deal with Article 7, which deals with PE, or Article 14, which deals with fixed pays. There could be any way in which India gets taxing rights. Then you look at the first column, 159 and 144D. Otherwise, you don't look at it.
Okay.
Okay, this is a proposition. Huh? You can take it to the and reflect upon it as all propositions under the Income Tax Act. There is no precedents available. I'm reading and interpreting the provisions as I understood them.
Yeah.
Now, last point is treaty allocates taxing rights to India, but under Article 7 or 14, where there is a P. This one, the second lot, there is no P. In the last lot, there is a P. If there is a P, if there is a P, there's a payment by a resident to a non-resident. It is taxable as FTS under the Act, but under 44DA. EL will not apply because the proviso excludes what is taxable as royalty or FTS under the Act. And since there is a direct accrual, ACP also will not apply. Right? And even if there is no direct accrual, let us say then since it is a royalty or FTS, anyway, under the Act, even though it is on net basis, being lay specialist, ACP will not apply. ACP will not have priority. And last point is NR to NR, there is a non-resident to non-resident payment and then E in it. EL will not apply because EL does not apply to non-resident apply to a payment by a permanent establishment in India. There will be direct accrual because there is a PE in India and ACP will not apply. So this is the scheme of understanding royalty and FTS interplay with SCP and equalization levy. If you notice, the last clause, the last column of SCP does not apply in any of these cases. That is because you just once it is royalty or FTS, lay specialist, and SCP is out of the window. Now, whether it is taxable as royalty or FTS, that will determine whether it is under 115 column, whether it is come under column 1, is royalty FTS under 115 or 44D, or will not fall under that clause. If it is not taxable as royalty or FTS, then it will go under EL. Then EL applies, and then in that case, again SCP will not apply. Right?
Excellent
So
Ganesh. Thank you.
I don't know whether you can punch holes.
I only commented on the tabulation.
Not the conclusions. I like that. So I think that's the whole idea. The whole thought process should be to provoke thinking. So we have participants also like going back and thinking on these lines and probably coming out with conclusions and then tell us where all I have gone wrong.
Yeah.
And lastly, one point is, last point only on this. This is one small, 918, or will take a minute. Last point is this: e-commerce. Do we have time for this, or shall we go ahead?
918.
This.
No?
Yeah, I'll go to 918.
So.
Yeah.
918. Yeah.
So 918 is a simple provision. Is actually it's been brought in. This was originally brought in to capture gifts outside India. Received by non-residents. They wanted to capture that also under the Income Tax Act in India, and they brought this deemed accrual provision applicable only to non-residents. So any sum income arising outside India, being any sum of money referred to in subclause 224(a), which actually refers to 56 to 10, paid on or after 5th day of July 2019 by a person resident in India to a non-resident, not being a company, or to a foreign company. So as long as the payer is a resident and it is a non-resident and it is a sum of money, this provision will get covered. If there is a relationship of a relative between the two parties, then the exceptions contained in 56 to 10 will continue to apply here also. Otherwise, though of course there is no separate a reference to that those exceptions, but this refers to 224(17)(a), which is why I believe the conditions under which it gets taxed in a residence scenario or in a scenario of of gifts between two residents will also apply here. This covers payment of only sum of money. It will not cover property that is excluded. Originally, they had put that property also in the bill, but they removed it. As I said, it includes only sum of money. It only talks about arising outside India. It does not talk about accruing or arising outside India for a simple reason: a gift cannot accrue, and income arising received, and sum of money is to be received outside India. Includes only a sum of money. As I said, transfer property covers sums received outside India. A sum received in India will anyway be includable under in scope 5(2). A remission of a debt will not be a sum of money received. It should not be covered. Let us say there's a non-resident who owes you money and you waive off that amount without consideration, or you remit that debt, it will still not be covered here because it is not a sum of money by a resident to a non-resident. And there's a threshold of 50,000 is available INR under 56 to 10. TDS obligation will apply, and DTAA, other income article, also will apply. So I think we are through. Now I think we can go back to questions. I'm sorry if I've rushed you on.
Yeah, you can, if there are questions, you can take a couple of questions.
Yeah. Rutvik, your baby.
Otherwise,
Yeah.
we can end up.
Actually, I have lost the chat because of my got logged out, but let us look at the Q&A. Yeah. So I think that one question is on SCP interplay with software, so that you've already covered in detail. So I'm skipping that question. There's another question on the India-Singapore DTAA on issue of a gift, and then in relationship with Article 13. Prima facie it is on relation to Article 13, and therefore I am not commenting on that. I think that's better be covered by person who's covered in capital gains or Article 13. Yeah, I think Q&A only has that. Chat box, I unfortunately have got nothing there now because I got logged out. So in case there are any questions balance remaining in the chat box, then they can just check up again.
No, nothing.
I find one if
one on 7.
If NR fails to permit.
Sorry.
Shall I say that?
Yeah, please.
Yeah.
There was one question. 1 second. Can we break after that? I'm reading. India for setting up a company outside India, but payment is made by resident from India to a legal consultant. So we discussed this. There was one of the cases which had, I think Shriram Capital was that case. You can refer to that. There's also one other case relating to the Brazilian sugar factory. I think I'm forgetting the name of the case, but anyway, those cases are discussed there. So it's replied there. Whether EL and withholding tax can both apply for the same transaction? Answer is no. When there's a EL 1050 exempts that from Income Tax Act, so obviously then there's no occasion to look at the withholding tax for that provision. And if NR fails to submit TRC under 94, say FTS is taxed in the other country as per DTAA, still one can take the benefit of DTAA by not deducting tax as per Section 195. Rutvik, it is your baby.
I didn't get that. Sorry.
I'll repeat.
TRC is not available.
Yeah. And FTS is taxed in the other country as per DTAA. Still, one can take the benefit of the DTAA by not deducting tax, because allocating taxing rates are there in the other country. So still, can one take the benefit of DTAA by not deducting tax? Without the TRC, can you take TT benefit? Is the question.
You cannot, as per 90 subsection 4. There are, I think, there is a Sparks, is it Ahmedabad tribunal decision, which is referred to that no section, this TRC condition, is at the end of the day a condition under the Act, and the treaty overrides it. To my understanding, access to a treaty, there can be some reasonable, conditions laid down by any government across the world. That is what my understanding is. So therefore, getting obtaining a TRC by itself should not be considered as violation of the double tax avoidance treaty principles. To that extent, a TRC is necessary. If it is not available, then treaty relief is not available. This is my view.
I think that's all. There are no other questions.
There's one on salary. Somehow I'm recollecting. There's nothing on the chat box, right?
No, I can't see anything.
Okay.
Unless it is before the break. So anyway, I think we are 8 o'clock. We have reached. So I think we should stop. Otherwise,
no, sorry. Here it is. Sorry, I'll
got
just
it?
finish this. Yeah, because it was an important point. What it is saying is that so as per there's somebody who has filed Form NR as per the latest circular for relief of dual tax residents, and in spite of this, the NRI cannot take benefit of salary not taxable in India, as per what case study probably had brought out of COVID-19 people who are stuck here due to pandemic. Yes, I would like to clarify here that even if a person is a dual resident, and that person is then we'll have to go under the tiebreaker test to determine where he is a resident of. And once that is done, then you will have to apply the Article 15 of the salary, because as per under the Income Tax Act, it will remain taxable in India if the person has rendered services in India, irrespective of his residential status. Then under the treaty, where is he becoming a resident of, under which country due to the tiebreaker test will be first determined, then you will apply Article 15 accordingly. Generally speaking, if the person, even if he is a resident of the other country, if the person here has been stuck for more than 180 days, he will still remain taxable. That person's salary will remain taxable in India, even as per the treaty. So there is a problem as far as those who are stuck here in India. I would put it this way, that each case will have to be looked at individually, but generally speaking, treaty may not give that much of a relief. That is what I would just like to add. Yeah.
thank you. Thank you all.
Thank you, everyone. Thank you so much. Yeah.
Yeah. Thank you both Rutvik and Ganesh Rajagopalan for really a marathon presentation of almost 4 hours covering the section 9. Almost more than 100 people are there listening to you for all the entire 4 hours. Once again, I thank you on behalf of Bangalore branch, and may I request Secretary Divya to propose a formal vote of thanks.
Yes.
If Chairman wants to say something.
No. Please, Divya.
Yes, sir. Dear members, I take this pleasure to propose formal vote of thanks for today's workshop. Thank you so much to both the speakers here, Rutvik Sanghvi sir and also Ganesh Rajagopalan sir, for spending your valuable time and giving an excellent presentation. Wholehearted thanks once again on behalf of entire managing committee of Bangalore branch and also on behalf of all the participants. Thank you so much. We're very delighted to have you here today, sir.
Thank you very much.
Thank you.
Thank you so much
Thank
for
you.
equipping all of us with such an excellent presentation. We're really blessed to have both of you today's session.
Thank you, Divya.
Thank you.
Thank you.
Thank you.
Thank you.
you.
Participants, thank you so much, all of you, for a very active participation. Request all of you to kindly look into Bangalore branch website for further programs. Thank you so much.
Very much. Good night.
Thank you.
Good
Thank
night.
you.
Good night.
Good night. Good night.